What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to work. Let's get your week started on the S&P 500. Just about unchanged. Good morning to you. Good morning's better than welcome back to work, isn't it? Good morning. It's going to be okay. Just 5 days and then we get a weekend.
Happy
Unchanged
Monday.
on the S&P. On a NASDAQ, negative 0.1%. On the NASDAQ 100, the weekly winning streak, 4 weeks long now on the NASDAQ. There we go. That winning streak, the longest since February. We had some more weight through last week on both the NASDAQ and the S&P 500, and finally breaking out of that very tight trading range on the S&P as well. For a brief moment, into the bond market, 2-year, 10-year, 30-year, 6 consecutive days of yields higher on a 2-year and a 10-year maturity. Yields back in this morning, down about 3 basis points on a 2-year, 423.87 on a 10-year, down about a single basis point to 365.93. If you want more Fed speak, you get plenty of it this week. Bullard, Bostic, daily. They speak today. Logan tomorrow. Waller on Wednesday. Then you get some Fed minutes as well. Look out for all of that going into this week. Tom, are you excited? Yeah. Okay.
The speakers, I mean, how many are next week? At 4 or 5 next week, until they go into their quiet period, right?
And then bingo. No Fed speak whatsoever until the Fed meeting.
Minimal value.
Minimal value?
Yeah, I just think it's minimal value.
Chairman Powell on Friday, minimal value?
That's different. No.
Take a listen to what the Fed chairman had to say.
We've come a long way in policy tightening, and the stance of policy is restrictive. And we face uncertainty about the lagged effects of our tightening so far and about the extent of credit tightening from recent banking stresses. Having come this far, we can afford to look at the data and the evolving outlook and make careful assessments.
Do they have the luxury of time not to hike in June, to wait, to look around? And I use that language very specifically and very carefully for a reason. I don't hear that word pause when the chairman speaks. And Neil Kashkari of the Minneapolis Fed over the weekend to the Journal, also going out of the way to make that point as well. If the committee chooses to skip a meeting because we want to get more information, I could make the argument why that makes sense. A skip to get more information is very different in my mind than saying, hey, we think we're done.
Yeah, I'm going to look at June 2nd, non-farm payrolls. I mean, it's just that simple.
And CPI the 13th is one thing.
CPI just before the meeting, I think, is way, way more important. Their data dependency waits to the last moment. Writing with Ellen Zentner at Morgan Stanley, their senior economist, joins us now, Sarah Wolf. Sarah, thanks so much for coming by today. I want to look at the economic data today. Lisa started the show with this morning, and that is the inflation data on Friday, PCE deflator. How sticky is sticky now for you and Ellen Zentner?
Core PCE inflation is going to look pretty elevated this Friday when we get it for the April report. As we saw in the CPI print, though, a lot of the upside is being driven by the goods side, which took a bit of a hiatus because used car prices came back up. We are seeing some nice alleviation in the housing components, and that's going to be key as well for the May CPI print during the blackout period ahead of the FOMC meeting in order for them to feel confident not raising rates again in June.
Debt crisis, no debt crisis. I got a 2-year yield, 4.24%. How does that change Morgan Stanley's view forward?
The debt ceiling is definitely of concern. A lot of the economic outlook no longer applies if we cross the X date. We know that it would be pretty catastrophic for the economic outlook. Almost 20% of household income comes from government transfers, Social Security, Medicare, Medicaid. We are looking to get closer to a deal. Biden and McCarthy are going back to the drawing table today, so it's a bit encouraging. But we know that all things are off the table if we cross that date in early June.
Say that again. 20% of household income in this country is from government transfers.
20%, most of it is Social Security. So imagine if you're an elderly household and all of a sudden you're not getting that Social Security check anymore, not getting that Medicaid check, unemployment insurance. I mean, it's truly an incredible amount of income.
Tom, I knew the number was big, but that big?
Yeah, I agree with that. I thought it was 17%, 16%. But, in the zeitgeist that all three of us read in this morning, is anybody talking about cutting off Social Security checks? No. I don't see it in the zeitgeist.
Well, they've got to provide an outlook when the Federal Reserve gets together in the middle of June. Very difficult to put one together if this is still playing out.
Exactly.
Let's pretend it's not for your benefit and for us as well. What do you think that outlook from the Fed is going to look like in the middle of June?
We still feel confident that the Fed is going to be pausing, and so they're not going to have to deliver another hike in June. Of course, it's going to remain data dependent. We're expecting to see a little more alleviation in that sticky core services component in the May CPI reading, but that's coming out during the blackout period. So really, the Fed speak this week, the Fed speak last week wants to set up markets to be pricing in what the Fed wants to do going into the June meeting.
To John's point, is it skip the new pause? And are they just going to keep skipping meetings rather than pausing ever and using the P word?
Well, they want to remain flexibility, two-way flexibility. If they need a hike, if they need to cut, they need to keep the door open. And so, yes, they don't want to explicitly use that word pause.
So over the past 5 days or so, we've seen a real about face when it comes to banks. On one side, we saw, Western Alliance come out and be a lot stronger, and people cheered crisis over. And then we heard from Jay Powell, still concerned about rapidly tightening credit conditions. We heard from Janet Yellen about possibly additional bank mergers. Today, Neil Kashkari wrote an essay basically saying we need to see banks raise more capital. What's your view in what the smoke signals are about where we are in this kerfuffle of banking?
Yeah, we're definitely getting cross signals, mixed data on the banking sector. What you definitely know is that Chair Powell still wants to reiterate that the banking system is stable, that things are still somewhat healthy. What's happening in the banking sector, though, is basically giving us more policy tightening than what we would need from interest rates. And that's what Chair Powell said on Friday, is that there's less risk of them doing too little at this point because you're getting this incremental further tightening in lending standards.
When you're around the table arguing, and anytime Ellen Zentner holds a meeting, there's a lot of argument. That's something that's good and healthy. But is a pause or skip? Did you call it a skip?
We're still deciding.
Jesus, if it's a skip or a pause, is it asymmetric or symmetric?
It's definitely a bit asymmetric. I think right now risks are still leaning towards probably having to do a bit more, especially if the soft landing scenario plays out. With all the hawkish Fed speak that we got over the past week, they're basically trying to push market pricing out, showing that they're not cutting rates anytime soon. So I think that, they're still leaning on the side of doing too much rather than too little. I think we got more hawkish Fed speak over the past week than dovish Fed speak.
Where's your cut call over at Morgan Stanley right now? When have you got the first cut penciled in?
We have the first cut penciled in for March of 2024. So we still have quite a ways to go before we get that first cut.
What's the backdrop that brings about that call?
We have core inflation coming down just below 3%. Jobs have been running around 40K for several months at that point. Unemployment rates above 4%. Really comes down to inflation, though.
They're the conditions that you're looking for, basically,
exactly.
Right?
Inflation below 3%, in particular services.
That's a whole different, what they're describing there is a whole different world after all. I mean, it's radically different than what we're living right now.
Well, you got to do one or two things.
That was Walt Disney.
That was beautiful. Great. I got it. Totally picked up on the Walt Disney line. Do you want to sing it?
No, I don't sing it.
All right, you going to watch The Mermaid? Little Mermaid?
I may, it's like big budget, you know.
Derailed already. Sarah, let's get back to the Fed talk. Got to make two calls here. One is the conditions that lead to a rate cut, and two, when you think those conditions will actually be achievable. What is it about the trend right now for inflation that you see dropping back to below 3 by, say, the first quarter of next year?
We've had a really good run on the good side, deflationary for several months, in particular motor vehicle prices. So we're not overreading into 1 month of prices coming back up. So we feel confident that that's going to continue to play out throughout 2023. Also, all the housing data is pointing to continued moderation in shelter inflation. And even though we got a step back up in the last CPI print, it's still below that 6-month, 12-month trend that we've had on shelter inflation. Also, we're seeing the labor market start to slacken a bit. Job openings are coming off, the hiring rates declining, fewer people are leaving their jobs. So all of that should be indicating that these sticky core services should be rolling over soon as well.
All of these put them together. And what we're seeing right now is ongoing resilience in an economy that has seen a sort of rolling recession in different industries.
Right.
And inflation is going to start peaking back up in certain areas as you start to see a recovery there. So what's the chance and how much has it increased of a June rate hike, of actually that meeting being live in a way that they kind of want to keep the door open for at a time when the market is just absolutely pushing back against what they're saying?
It's still live. We get another jobs report, another inflation report, as you mentioned. So what gets us there to another hike? Another whopper jobs print, maybe somewhere close to 200 or higher. If core inflation is close to 0.4% again next month, in particular, if that services component is reaccelerating, I mean, that squarely puts a June hike back on the table.
The thing that people are worried about, the reason why a skip or a pause or whatever you want to call it is on the table is because they don't want to see some sort of financial crisis really prompted by their policy. So at what point are they getting into the fragile zone? Do we have a sense of that? At what point all of a sudden additional rate hike is the make it or break it kind of point?
I don't think that we're there quite yet. Banking conditions are still somewhat stable. Credit conditions are tightening, but it hasn't gotten too extreme. It's tough. It's a tough call for them. They're going to be watching the data as it comes in, but we're not quite there yet on if it's one hike. I mean, right now we're just playing with 5%, 5.25%. I don't really think that 25 basis points is a make it or break it for the Fed at this point.
We're all focused on the 2-year yield, 4.24%. I just looked at the 30-year mortgage. In 6 days, it's moved 6.8 something percent, 7.04%. I don't think anybody's talking about that.
Yeah, the housing market, it's a big push and pull right now. I mean, the second that affordability pressures ease, you have all these people hopping back into the market. So it signals that you need to keep rates high because otherwise you're going to see that inflood of demand again. We get quite a bit of housing data this week as well. That's actually starting to show some incremental improvement in the housing market. But then, as you said, mortgage rates come back up, demand's going to come off again.
Just amazing. What do you think that's about? Do you think that's about inventory, lack of supply?
I mean, there's just a huge demand still for housing. We have lack of supply. And so, I mean, you have this huge population of prime age home buyers that are waiting to get into the market, bummed that they missed their chance when we had 3% mortgage rates. And so once they see some alleviation in mortgage rates and home prices are coming off a bit, we saw existing home sale prices come off by over 1% last week. People are hopping back in.
I'd like to see more of that in New York, would you, Tom?
Right.
I'm always, whenever I'm talking about these, which side of the trade
anybody's
I'm
talking
on.
about.
I think everyone knows, right? You just need to see a little bit more of that, maybe a whole lot more of that. Sarah, well, thank you.
Thanks for having me.
We keep setting policy for the boomers. That's the problem, TK. We're looking after their house prices.
The
millennials want to get in. They want to get in, and the boomers just won't let it go. Just won't let it correct.
You turned to me after it clearly wasn't going to bite with him. So he's basically...
He's coming in. I'm recruiting you. I'm recruiting you.
To what?
Just getting you on my side before TK comes back with something to say. Tom, the floor's yours, please.
Early April, the mortgage is 6.70%. Life is good. We're moving in the right direction. Lisa brought it up, blah, blah, blah. Boom. Complete reversal.
Just supporting the asset price of boomers, Tom. That's been the last 20 years.
Well, you did it last week. You had rented $4,100 a month in Manhattan.
Which?
Yeah, for a walk-up.
Yeah, but that probably would get you a warm walk-up in Manhattan.
I'm on the 7th floor walk-up.
4,500.
4,500, yeah, probably 5th floor walk-up.
Now, a TK's getting so expensive. It's ridiculous.
It's ridiculous.
Sabadra Rajab for SocGen coming up. Sarah, this was great. Run. If you stick around, this gets messy. It really does. Yields down a basis point, a 10-year, 366 from New York. This is Bloomberg.
Keeping you up up to date with news from around the world. With the first word, I'm Lisa Mateo. Facebook owner Meta Platforms is hit by a record $1.3 billion European Union privacy fine and given a deadline to stop shipping users' data to the U.S. after regulators say it failed to protect personal information from the prying eyes of American security services. Meta has 5 months to suspend any future transfer of personal data to the U.S. and 6 months to stop the unlawful processing, including storage in the U.S., of transferred personal EU data. China has questioned the sincerity of the Biden administration as it pushes to resume high-level diplomatic talks with Beijing. A Chinese foreign ministry spokeswoman saying, quote, the U.S. side asks for communication on the one side, yet on the other, suppresses and contains China by every possible means. President Biden says he expects ties with China to improve very shortly, dismissing an alleged spy balloon that caused a diplomatic spat earlier this year as, quote, silly. Micron Technology stock fell after China delivered the latest salvo in the escalating chip war with the U.S., announcing that Micron products have failed to pass a cybersecurity review. Beijing has warned operators of key infrastructure against buying products from the American firm due to cybersecurity risks. The U.S. Commerce Department says the ruling has no basis in fact. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities.
We could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
There's always uncertainty about tax receipts and spending. And so it's hard to be absolutely certain about this, but my assessment is that the odds of reaching June 15th while being able to pay all of our bills is quite low.
Janet Yellen with a pretty bleak outlook for Treasury and the cash balance at the moment. The U.S. Treasury Secretary speaking on NBC over the weekend. From New York City, welcome to the program on TV and radio. This is a price action right now in the equity market. We are negative by not even 0.1%. No drama here. We're down by 0.07% on the S&P. Yields come in about a basis point, 10-year, 366. The headline at the last hour from JP Morgan, boosting its outlook after the purchase of First Republic Bank. And Thomas, we've been joking, and you've been joking, really. You've been on top of this over the last couple of months. It's like they're doing this with their hand in front of the face, sort of, we're boosting our outlook. Things are okay. almost embarrassed of how good things are at the moment.
People led by you, I bust my chops about the history of it, but the history is real. Let's review it really quickly here. The nation blew up in about 1840. Andrew Jackson said, no, we're not going to do this. We don't trust the big cities. And that was the second bank of the United States. There was a third bank in 1870, whatever. The fourth bank was considered to be in the library of J.P. Morgan's mansion on Madison Avenue, the founding of the Federal Reserve. Is this the fifth bank of the United States, the combination of J.P. Morgan and Bank of America? I don't even put the other ones in there.
You don't even talk about the others anymore.
That's the scope and scale here.
Huge, and getting bigger.
That's big. Right now, it's very important to have with us, because she knows all the names. Shonali Basic's with us as we look at the law firm Pinto, Lake, Peepsick, Barnum, and Petno. Today, they're going to do a road show, right? Mm-hmm. How is their road show different? Because James Gorman waltzed out a week before and said, I got 1 year left.
Listen, the succession race has certainly been watched very closely over at J.P. Morgan, especially because Jamie Dimon has been there for a long time. And over the last decade or so, we've seen so much top talent come in and out of J.P. Morgan. Many of those people are leading other companies now. Think Charlie Scharf, for example, over at Wells Fargo. So that eye on Marianne Lake and Jennifer Pipsack is pretty huge.
What about Pinto, Barnum, and Petno?
Well, it's kind of always seen as Daniel Pinto has always been kind of the man in the envelope. When Jamie Dimon has gotten sick, he has stepped up, he has taken over. But the succession plan lies to these two women. And so the question is when? I think that is the bigger question, almost more than who at this point. Is J.P. Morgan ready to toss the baton on at all?
We talked about an elegant solution provided by James Gorman over at Morgan Stanley. You and I did on Friday. I just wonder what that would be thought of over at J.P. Morgan. Just this idea that someone as big as Jamie Dimon might think about becoming the chairman and just staying there as the chairman and occupying that sole seat. At the same time, someone steps up and takes the CEO role.
Well, yeah, and it's executive chairman over at Morgan Stanley, too. So you would still presumably have somebody else really leading the board there. Executive chairman being almost kind of an advisory role. That is an elegant solution. The other question, though, is with Morgan Stanley, they have folded into major acquisitions. They have made a lot of progress in doing so. Can J.P. Morgan move on without integrating First Republic at scale a little more?
And what's next in terms of acquisitions? There was this Wall Street Journal article over the weekend saying that J.P. Morgan now accounts for 13% of the nation's deposits and 21% of all credit card spending at a time when supposedly we're still worried about too big to fail, but not really, because those actually were the banks that survived. I mean, how much are they going to try to hide their scope and scale in some of these meetings?
I think pretty intensively, in the sense that you see very high up in the presentations already the conversation around heightened scrutiny on banks and the heightened costs tied to the FDIC assessments and what that could mean for future costs for firms like J.P. Morgan. There's about 4 or 5 different bullet points on just the uncertainties around the different types of regulations they'll face around the world. When it comes to banks, remember, for First Republic, they kind of had to waive this idea of a deposit cap here to bring on a new depository institution. Their rivals were actually kind of skeptical here. Certain rivals were very skeptical that the government would let them buy FRC in the early days. By the end of the process, there was more certainty here that J.P. Morgan could keep the cost lowest for everybody. But again, remember, they did have to waive rules to get this to happen.
The fact that this is high up in their presentation and the fact that Neil Kashkari came out with this essay this morning talking about how he would like to see higher capital requirements for all banks, but particularly the too big to fail banks, he pointed out. Do you get the sense that this is a very serious proposal, or do you get the sense this is a lot of lip service to kind of gloss over some of the recent turmoil?
I think something I worry about when it comes to bank regulation is how much it changes under every future administration. I think what's interesting here is that under the Michael Barr era for the Federal Reserve, there's a sense that things can change pretty quickly here, not without pushback. Jamie Dimon has been one of the biggest, most vocal critics on some of these stress capital buffers, and when you look at the requirements under the stress testing, saying we have passed them over and over. Their own current assumptions here are kind of more than what you see. It's for this year alone a 5.8% unemployment rate peak when they're thinking about the reserve. So they're reserving more than what you're seeing in the market per se. So they're saying we're doing the work here. We don't need more work. You're going to choke off the banking system is the threat here at a time where you need credit in the market.
We forget the scale. Morgan Stanley employees, 82,000. JP Morgan employs 297,000. To John's point earlier, we're making jokes about it, except it's not a joke. Are they soft selling how profitable they are? Are they going to play down the ginormousness of the bank?
Soft selling. They could soft sell all they want, but you and I know they ink the highest returns on equity in all of Wall Street by a significant margin when it comes to the biggest of the banks. There are some smaller banks that just by profitability can do better. But listen, to your point, they're large. And by the way, if you look at their statements here, their presentation, they have levers. They continued efficiencies is one of the little bullet points you'll see deep in that press release and in these presentations. They can cut to become more profitable if they want to, but they're already quite profitable.
Just want to be really clear about something that James Gorman's talking about 12 months and Jamie Dimon's still talking about 5 years. So if you are just tuning in, there's no immediate conversation about Dimon headed towards the exit.
We're trying to create some excitement here, but
Can we finish on Morgan Stanley just briefly? Sure. Another thing we were discussing going into the weekend, Shonali, together was reflecting on the time at Goldman Sachs when Lloyd Blankfein was saying it's time to go. And then you had this really sort of awkward moment between Harvey Schwartz and David Solomon for a little while. Can you tell us, waking up this morning, what Morgan Stanley's going to look like over the next several months? How much tension there will be between these two individuals?
We have seen this fight play out over and over at Morgan Stanley, where they say they will make an announcement and then they wait 6, 8, 12 months before they give folks the job. This Ted or Andy conversation, they call it inside of Morgan Stanley, has been a conversation for many, many months. It's the parlor game of Wall Street, really. So the pressure on Ted Pick, who runs institutional securities, and Andy Saperstein to just perform, to show which one is the ultimate leader, I think is really something to watch.
Are you telling me we still haven't made that decision? You think they still haven't made that decision at Morgan Stanley?
You know, it's interesting. If they've made the decision, it's pretty closely held. And so the drama is real. But have they made their minds up? I think it's a tough one on this one.
Succession at Morgan Stanley, Tom. Is that going to work for you? No spoilers. I still haven't seen the final
episode. This feels medieval. It's like, come out there with a lance and see who survives, and then they're just sort of,
Somebody asked me over the weekend, why is it like this? Why are you following this? And the issue is, and Shonali, help me here, if you're not picked, you leave, right?
That's been the standard. We were talking about co-presidents earlier. Can that be something that's done? It doesn't work. It's not traditionally worked. But it's not just them they leave. Do some of their key deputies leave?
Yeah.
And this is a very loyal bank in terms of all the people that are under these two men in particular, and Dan Simkowitz, who runs investment management. So you worry and you think about attrition.
Leave and maybe turn up somewhere else. Harvey Schwartz turning up at Carlyle years later.
Yeah, no, but it's I can't even say it's a new tradition.
Pruzan just left too. Tradition. Remember, Jonathan Pruzan, the COO, longtime contender. We're waiting to see where he ends up too.
Are you connecting that story now to what has happened in the last month or so?
You have to hire from within, I think. When you look at the CEOs, I think it's a really tough case if you bring in somebody externally. I've been asking, can Charlie Scharf come back and lead JP Morgan, for example? Can you bring somebody back? And I think it's a really tough sell when you have a bench.
Were you up at Oak Hill this weekend? I mean, you're such a hitter. I mean, all the banks are up there. They're all doing a financial ballet.
Weekend, Tom.
I had no idea.
Break.
I've never been up there, Tom. Oak Hill looks beautiful up in Rochester, New York. It looks beautiful.
It is. It's Kodak money from a million years ago, 1926, and they built it out, and then what they did is they restored it. And John, those bunkers, when I caddied there, those bunkers did not look like that. I'll tell you that.
So much more classy than talking about the interns in the Hamptons.
Clearly.
With David Solomon.
So much better. TK, I'm not going to let you gloss over that. You caddied Oak Hill back in the day.
I caddied Oak Hill, the Trevino 68. I had the honor right in this room, actually, to speak to Lee Trevino about how he changed golf.
That's
it was
very cool.
really, I talked to him about driving down Kilbourne Drive and what was it like before you stepped onto Oak Hill. And he had tears. He really got emotional.
If Jim Nance ever wants the day off, step into the booth, TK.
Coming up, Shonali Bassick will address the tea at Little Poison.
From New York, this is Bloomberg.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited, finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The recession that everybody's been waiting for isn't coming, hasn't come.
We are investing into a slowing economy.
Consumers kind of moving towards the front end, institutional going towards the long end.
We think the Fed is going to keep rates higher for longer.
The risks are that they don't even cut this year, they start to cut next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Coming up, a week of debt ceiling negotiations and Fed speak. Stay in bed. Live from New York City this morning. If I had the choice of doing the same thing, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures just a little softer on the S&P 500 after a decent week of gains on the S&P. A week of gains, higher yields, even with this conversation around this debt ceiling drama. Speaker McCarthy, the President of the United States, those talks will resume a little bit later on this afternoon. For TK at the moment, it's kind of good, then it's kind of bad. Talks are okay. We're moving forward. We're not moving forward. We're stepping away. Where on earth are we?
Yeah, for Global Wall Street, we're going to have a great conversation on this with Goldman Sachs London here on the range that we're in. But, John, to start a Monday, futures 4201, Dow 33.5, NASDAQ touching near 14,000. We're at the top, the tippy top of the recent range.
4 weeks of gains on the NASDAQ. And Lisa, that gain last week took place even with decent data, better than expected in many places, pushing yields higher through every single session last week.
It was artificial intelligence hype gone absolutely bonkers, or basically people are saying this time is different. And you heard that over the weekend in a number of different analyst notes. You know, you started the show saying we're going to get debt ceiling negotiations and Fed speak, so stay in bed. And I think macro is staying in bed. And that is the reason why we're seeing this range, even though the stories underneath are getting a lot more interesting. And I think that's been a theme that's been sort of head spinning for the people trying to discern some sort of macro theme. But under the hood, there's some real changes going on.
I agree
People are focusing
strongly.
on.
The yield space is what to focus on this week. We're all going to look at equities. Can you imagine 4,300 on equities back to where we were a year ago? Forget about it. What I'm looking at is the yield, 4.24% two-year yield. And we mentioned in the last hour this surge in the 30-year mortgage, John. Early February, 6.45%. We're now at 7.04%, above 7%.
Are we finally going to see that price correction off the back of that? Because it's hardly gotten started. We're talking about rebounded housing activity in America now, Tom, with 7% rates.
John, I don't know. I was in a restaurant Saturday night, and they said, when is Farrell going to do the real yield again? The real yield, 1.41%. 1.41% on the 10-year real yield, John. We don't quote that like we used to.
TK, that's rude. That is rude. I want to get to this.
That silly week.
You talked about getting beneath the hood of all of this. Okay, this is Mike Wilson and Morgan Stanley. There are many technical signals that conflict with the idea that this is the beginning of a new cyclical bull market. And here are the list provided. Here is the list provided by Mike. Extreme narrowness, so poor breadth. This is all tech, all of that stuff. You've heard that stuff before. Lisa, quality defensive leadership and broad cyclical underperformance. Small caps, think banks, regionals, etc.
So I was talking with Neil Dutta on Friday, and I was pointing to all of these different indicators that point to a Morgan Stanley's Mike Wilson view of the world. And he said his first indication say, okay, boomer, none of these signals work anymore simply because we are in a new paradigm. And here's the question. Are we in a new paradigm with respect to the underlying drivers perhaps having some mixed signals, but kind of the cross currents not coming up with anything conclusive in the same way?
This is a huge deal. It goes to the theme of my book of the summer from Olivier Blanchard, the other factors that are out there. And is one of them a technology overlay? John, you mentioned NVIDIA. I don't even know what NVIDIA does, to be honest. But the answer is that these tech companies on a moonshot.
It's flying.
They're on
That's
a moonshot.
That's what you need to know. Meta as well. Top two performing
Facebook.
names on the S&P 500.
But they're down a little bit today. They got the European timeout share.
That was good. Okay, let's move on. Here's the price action on the S&P. Down 0.1% on the S&P 500. Yields look like this in a bond market, down a single basis point, 10-year. Lisa, 365.93.
All right, today we do get more debt talks, which I know everyone is so excited about. President Biden and House Speaker Kevin McCarthy resuming talks. Biden in Washington after his trip. I got to say, they're going to say something. It's going to be constructive. Then tomorrow it's going to be negative.
For those of you on radio, couch photos.
Right.
That's where we are right now.
Exactly. Wednesday, and talking about NVIDIA, the chip maker, they're going to be reporting earnings after the bell. They're up almost 114% really year to date. So just a small 114% move. Key for me is how much are they going to ratify some of the hype around AI, around ChatGPT-like technology? How much are they going to increase some of the projections, even in the face of some tensions with China? And this week, in terms of the data front, in addition to all of the Fed speak that John was mentioning earlier, we get global flash PMIs tomorrow, FOMC meeting minutes on Wednesday. And really, this is the key. PCE inflation data on Friday. If you end up seeing inflation, this key metric that the Fed looks at as being sticky, how much does this challenge the idea of a skip? Not a pause, but a skip of the June meeting.
This is the new word for April, right? For June, I should say.
They've been very careful about not calling this a pause because they don't want to communicate that they're done unconditionally. They don't want to do that because we're pricing in cuts still in the back half of the year.
When you were a kid, could you skip rope? Like, this
I wasn't
thing
very good at that.
I was
wasn't
terrible.
Good at that.
I was
loved
terrible.
it.
Did you?
Of course.
I can just see you cranking it out. Getting
like,
ready for Coventry and,
Well, skipping ahead of football, I don't think so.
Yeah.
Lisa mentioned the couch photos. Very controversial couch photos, you know.
Oh, I missed this.
The hybrid shoe worn by certain U.S. officials. The hybrid shoe. I'm sure you can see it in the shot there. It's this hybrid of a sneaker and a dress shoe. Have you seen these?
God.
Very controversial. Great New York Times piece over the weekend. If you get the chance to have a read, have a read. The hybrid shoe, TK. You a fan of the hybrid shoe?
No.
Worn by people like Speaker McCarthy.
Sartorial criticism with John.
That's what this is. That's what this is.
That's literally.
If you're going into the Oval to meet with the President of the United States,
you don't wear a hybrid shoe.
You're going to wear like this thing with this white sole.
Literally, you need to have your own collar.
10 Downing Street. What would Boris do? I can't see Boris in a hybrid.
I'm not sure when you go to meet the President, you want to ask yourself that question, Tom.
Yeah.
What would Boris do?
WWBD.
Probably not the greatest start.
Rishi Sunak's going to have some fancy custom-made shoe.
Rishi would know what to do.
He would know what to do.
Without a doubt. without a doubt. You would just wear a nice lace-up, Oxford. Just, you know.
Sharon Bella's going, did I sign up for this?
Sharon agrees with me. Sharon Bell joins us now, Senior European Equity Strategist at Goldman Sachs. Sharon, I'm going to start here, not with that. Start with the equity market. There's been some pushback against the overweighting of the rest of the world, Europe, China versus the United States. From your peers over at JP Morgan, Mislav Matejka, they closed out their overweight Europe versus the United States. Sharon, where are you on that debate right now as a team?
Yeah, we still generally like non-US markets to the US because we still think the US is on the more expensive side. We don't have any upside for the US market for the S&P. In fact, our end-year target for the S&P is 4,000. That's below where it is today. But we don't expect a big bear market either in US stocks. We just think that they're in a kind of fat and flat range and we're more toward the top end of that range. And for the rest of the world, cheaper markets generally. Japan has been exceptionally cheap, performed well more recently, but Europe too still.
If you have a fat and flat range, I love that phrase, it really captures the mathematics. Critical question, do you trade the range or do you almost go buy and hold and just oscillate through it till you figure out what to do?
Yeah, I mean, it means that you don't have to make dramatic shifts in your portfolio because you're not looking at an environment where we're expecting huge upside or a very dramatic bear market and large downside. I think the problem with the fat and flat range at the moment, though, is first of all, we are towards the top of it. And secondly, there is a competitor asset out there called cash, which is now offering you 5%, which relative to a fat and flat range looks quite attractive. So if cash was at 0, then that's not really a competitor. The fat and flat range might be good enough for you and you getting dividends and things like that, the optionality of upside over the longer term and equities, etc. But when cash is offering you 5%, then actually that looks relatively quite attractive.
Sharon, you're talking about how you like ex-U.S. assets more still, although we were talking last week about how the data in Europe is starting to roll over just a touch, whether it's forward-looking surveys or PMI data or anything related to China's recovery. At what point would that get you to rethink whether a sort of overweight European bias really is the way to go?
I think the data on Europe has been a little bit mixed. You've had sort of some of the industrial data, particularly out of Germany, a little bit weaker, and that for sure may be related to China and the weakness in the data that we've seen there in April and May. And bear in mind that Europe is very exposed to that sort of export route, that trade route, especially Germany. But elsewhere in Europe, the consumer data is still very strong. The labour market data is good. The services side of the PMIs are very good. So I don't see Europe as overall in danger.
Sharon, Rishir Sharma had a blistering essay in the Financial Times over the weekend saying people like you have it wrong. Wall Street is talking about a booming China, a 5-6% GDP reset. Dr. Sharma says, maybe not. What's the new amendment at Goldman Sachs on what the Pacific Rim and China will do, and how does that fold into global prosperity?
Yeah, I mean, definitely China is disappointed in the last couple of months, both the consensus and our own estimates. The PMI data has been weaker in China, but also the hard data, things like fixed asset investment, retail sales, industrial production have all weakened in China. We do think that China growth will be reasonably good this year, but we think next year growth in China will only be running at around 4.5%. In our view, the Chinese authorities are pinpoint easing particular parts of the economy, looking to target particular parts that are especially weak, like youth unemployment, for example. But beyond that, they don't want to do broad-scale easing in China. You still have the property market, which is over-levered, will take some time to unwind. You still have other issues in China, such as the shrinkage in the population. You still have the US-China relations, which have obviously soured in recent years, and that's hitting China trade and growth. So there are, I think, a lot of underlying negatives on China. So I don't completely disagree with that view that China's vulnerable. But I guess the China equity market's extremely inexpensive, and that perhaps already reflects some of these risks.
Sharon Bell of Goldman. Sharon, appreciate it. As always, Europe this summer set to absolutely boom on the services front, travel and leisure. Look out for Michael O'Leary of Ryanair a little bit later on this morning. Looking forward to catching up with him. Do you want some reviews, guys? Here you go. Cult menswear commentator Derek Guy called out the footgear as a clear lapse in dignity. The style director of GQ called it, quote, awful. This New York Times piece is amazing. Honestly, the footwear of Hakeem Jeffries and Speaker McCarthy in the Oval Office.
Honestly, my favorite is every Monday morning. The one thing that gets you the most jazzed up.
It's amazing.
Is sartorial reviews.
Do dress sneakers belong in the Oval Office? That was one of the best things I read this weekend.
That tells me a lot on many levels.
I may not agree on the shoulder cut, but I'm fully on board with the Pharaoh criticism.
Really?
Yes.
What about your hybrid Gucci's?
Well, I don't
They're
have
not
the
Gucci's,
hybrid
they're
Gucci's.
Pradas.
No, I had to go to Pradas.
They're hybrid Pradas, right?
Oh, you know, come on. Yeah?
No,
wouldn't wear them in the
Gucci's coming
Oval.
back.
That's
Gucci,
true. That's true.
Gucci let the guy go that was doing all the goofy stuff, and they got the new conservative guy coming in.
Oh, how's that going?
Yes.
Because they've been struggling, haven't they?
Soon.
Okay.
I happen to have been in the store, don't ask why, and I got a full briefing. The guy's here, and he's moving quickly.
We should do this segment more often.
Yeah, Celine
Equities
looks good, too.
Down by 0.1%. We won't talk about them.
No,
Let's not do
Celine's,
that.
You know, they're talking to me about
I'm sure. A collab?
Yeah, a collab. Yeah.
They're a big thing these days, Tom.
They are.
Yeah, from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukraine reported damage to dozens of buildings and vehicles in the southern city of Dnipro after another barrage of Russian missiles overnight. Ukrainian forces say they managed to shoot down 4 of the 16 missiles launched, as well as 20 drones. President Volodymyr Zelensky is expected to return to Kyiv after attending the Group of 7 summit in Japan, where he suggested Russian forces are losing control of the eastern city of Bakhmut after months of fighting. President Biden and Republican House Speaker Kevin McCarthy are set to meet today for talks on averting a catastrophic U.S. default as time runs short and key differences remain. Negotiations have been whipsawed between progress and deadlock for days as the two sides simultaneously grapple for political advantage and a deal. Handpicked negotiators met Sunday evening at the U.S. Capitol. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
The moment news breaks, no one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your Global Business Authority.
You just said, I'm willing to cut spending. Speaker McCarthy says that the U.S. government needs to spend less next year than they did this year. So will you agree to that?
We have agreed to cut spending. We've cut spending, and we're going to continue to cut spending. But the question is, what base do you start from? You just calculate what it means if you take all discretionary spending and you make no distinctions other than what the percentage number of the cut is. And some of it makes absolutely no sense at all. And so what we've done is we're going to have to sit down. I'm hoping that Speaker McCarthy is just waiting to negotiate with me.
And we're waiting for just that a little bit later. AMH and the President of the United States at a G7 in Japan. That G7 interrupted several times. The President needing to leave a dinner early, one occasion. On another occasion, flying back on Air Force One, taking a call with Speaker McCarthy, and we're told that call went wow, that it was constructive. Some soothing words, Tom.
Yeah, flying back, he probably watched Succession. And, you know, between Jess and Rob, I just think it's just too much.
Don't you dare ruin this.
I'm not going to ruin it.
Don't you dare.
Judd, who was the one person in the United States of America that couldn't get through season 1 of Succession?
You didn't like it?
I just don't have the time. I actually enjoyed it to a great extent, but I just don't have the time.
Season 1 and 2, good. The rest of it, nah.
That's what I've heard from a lot of people.
Take it or leave it.
You know,
but I think once you're in it, you kind of want to complete it.
But I mean, Jess, I mean, it's just, you know, and Rob, I mean, there's some tough decisions to make.
Where are you taking this?
Oh, we're going to Anne-Marie Horton. She's watched that.
What's Rava got to do with this?
Rava, there's some huge tension here.
Oh,
you know.
Okay.
You think he's got an answer to that?
I think he's read something. You never know. That's the problem with TK. You never know. He says everything with such authority.
Yeah.
That it might be true.
So carry on.
My whole career anchoring with him. It's like half on Google, half on air.
Bloomberg's
is it real?
Just like him.
Joining us now, Bloomberg Succession correspondent in Tokyo, Anne-Marie Horton. I'm sure will catch up on all the episodes.
Don't ruin it for me.
You too. That's true. Let's. The word I heard there, seriously, Anne-Marie, was the President of the United States using the dreaded H word, hope. What does he hope for?
Well, obviously, this meeting today is going to be an important one. And if you look at the months-long debt negotiation, it's a pivotal one because no one else is there. McConnell's not going to be there. Schumer's not going to be there. Hakeem Jeffries is not going to be there. This is Biden and Speaker McCarthy. These two men are the ones that are going to be able to get the deal done. What is interesting about the phone call that took place as the president was heading back to the United States from Japan on Air Force One was that it then broke this impasse for the negotiators to then get back in the room on the Capitol for a few hours. So I really think what's important today is just we wait and see the communication that comes out of this meeting and if there is going to be a deal. And then we can get into also how difficult whatever deal these two men cut is going to be for them to also get through Congress because obviously Kevin McCarthy has a very slim majority in the House, but then also the Democrats have a very slim majority in the Senate, and both of the wings of both of these parties are not going to like a lot that is going to get done if it's going to be a proper negotiation.
A completely unfair question, Anne-Marie, with you in Tokyo, but I'm going to go there because you're so read in. How much is Mr. McCarthy right now like Mr. Boehner? How close on the Horton measurement is he to being an exiting speaker?
So I think everyone has misjudged him in this moment only because everyone was pointing back to how long it took him to get the speakership. That was the 15 rounds of voting. And yes, it was very slim how he was able to get through with 217 votes his bill that he's using as leverage to get Biden to negotiate. And the last person to vote for that, by the way, was George Santos, potentially a member of Congress that won't be in his camp at some point, given the ethics review on that individual. But at the end of the day, he was able to keep his caucus secured. Many say that he's been very informative with his caucus about what needs to get done. And at this moment, he was able to bring Biden to the table. Biden said he wouldn't negotiate on this. Now, the White House continues to almost do verbal gymnastics, and they pain themselves to say we're not negotiating on the debt ceiling, we're negotiating on the budget. But they wouldn't be negotiating on the budget at this moment if Speaker McCarthy said, I am not passing debt ceiling bill. if I do not have fiscal spending cuts. So we have to wait and see how this works out. But so far, he really does seem to have the support of his party behind him.
mate, we're all super tired of the mood music headlines of the last week or so. Can you help us out with the substance? Where have we actually made some real progress?
So there's one real point of progress on the Republican coming inside. They wanted spending caps for 10 years. It does seem like they're able to narrow that to potentially around 6. Things like unspent COVID funds, I think Democrats will get on board with. But, Jonathan, really, it's the top-line figure on spending and what baseline. And that's what the president was getting at in response to my question. He said he is willing to cut spending. Speaker McCarthy says they cannot spend more next year. They actually need to spend less next year than they did this year. What the president is saying, he's willing to cut spending, but he wants revenue raises. Now, Speaker McCarthy, in an interview with myself, said his 2 lines are, I will not raise taxes and I will not pass a clean debt ceiling. So the issue they have now is going to be how much they are willing to spend next year and from what baseline that's coming from. And if they're able to hammer that out today, that would be key. The other big debate, of course, is going to be work requirements. The Democrats do not want to see work requirements, especially when it comes to access and health care. But this is important to a large chunk of Speaker McCarthy's caucus.
I feel like this is like a Peanuts cartoon where when the adults speak, you just hear wah, 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 wah. And that's like the debt ceiling debate. Basically, every time it's like this, and then everyone just kind of nods off. Is there a greater likelihood of default after this weekend's turmoil or not? I guess that is, the people who you speak to, the experts, what do they say on that front?
Well, everyone has a probability, right? There used to be probabilities in the past that, it's a 10% chance we can default. That has grown for a lot of asset managers I've spoken to, and they are developing contingency plans. I think what was telling was Treasury Secretary Janet Yellen on NBC News' Meet the Press, reiterating what she also said to me, which is at some point, we would default on something if we are past that date. And I think potentially this White House is going to have to start actually thinking of the contingency plans. Are you going to just service debt? Will you pay off Social Security recipients? And Janet Yellen made it pretty clear that she thinks June 1 is a hard deadline. So that potentially is getting some people a little bit more nervous. But I do think very much so for the markets, it's probably a wait and see mode at this moment to hear what the president and McCarthy has to say, because these are the individuals that hold the power in the negotiation.
Would you like the final word on the hybrid dress sneaker? And then we'll leave it there.
I think Amory Horton was authority on this.
Doing research.
So my personal opinion on sneakers in the White House is it is definitely a no.
There we go. That's the official word. I think that's like
That's
the
why
Bloomberg.
we love her.
That's the Bloomberg lead now.
She goes,
on
Monday she's Chanel, and then, never Louboutin.
What is Speaker McCarthy and Hakeem Jeffries doing there? I mean, come on, Bramo. What are they doing there? It's ridiculous.
Well, okay, I was looking at, I think it's a little much of a stretch to call it a fashion hate crime, which is what some headlines were saying.
Is that what they called it?
Someone called it a fashion hate crime, which is pretty intense. Yeah, that was the Free Beacon.
John, help me with
culture.
the socks. I mean, come on, John, you're a pro at socks. I wear boring maroon socks. I wear the socks King Charles wears. What are those socks?
If you want to wear like fancy dress socks, you've got to do it with a pretty sort of elegant suit and nice, elegant footwear to go with it. I mean, that's just a no. That's
agree.
a hard no from me.
Okay, there are two
on
things.
radio, people are driving off the road on radio right now.
Two things. Respect is really important.
Agreed.
And if it's seen as disrespect, that is a problem. If it's just simply a fashion choice, they should be focused on other things like having this nation not default.
Agreed.
Do you know what my mother used to
both
call
counts.
it?
Bravo, thanks for that.
Do you know what my mother
Really
used
good
to
stuff.
call it?
What's that, Tim?
American slob.
Yeah?
That
Oh,
was
you
her
go that
phrase.
far. Wow.
Oh, Mike, she was
Brutal.
She was
Scathing.
Oh, yeah.
That's a proper review, that is.
Yeah.
Is it?
Yeah. That's up there. That's up there, TK, with GQ. You just called this awful.
Yeah.
Awful.
Terrible.
All right, guys.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from New York City, counting you down to the opening bell, about 2 hours away. Here's the tone of things right now on the S&P 500. Just a bit softer, negative, lower by 0.1%. I keep saying it, no real drama. The drama on Capitol Hill continues later. I can't even take that seriously.
None of us can.
The debt ceiling negotiations pick up once again. We've had headline after headline about the mood music. Let's talk about real numbers. As of late last week, I think this data from Thursday, the Treasury's cash balance was at just over $57 billion. $57 billion, down from 140 the week before. TK, that's what you've got to track, not the mood music,
Totally
the numbers.
agree. Where is it now? Do we know where it is now? And the answer is it's south of 50. I mean, that's the trend that's in place.
Feels that way. As you know, Tom, can be really lumpy because of tax receipts, but ultimately it's heading in one direction, and that's lower over the last week.
What time do they meet today? Actually, that's important.
I haven't got time on that yet, Brammer. Have you got one
Their day
yet?
starts at 12 noon. So
Their day starts at 12 noon.
Oh, yeah.
I think the president had a long flight back from Japan,
Oh,
so
yeah.
we'll
Can you
see when that
imagine?
gets started.
Wow.
In the bond market, 2-year, 10-year, 30-year, 6 straight days, 6 consecutive days of yields higher. Take a break from that this morning. We're down 2 basis points on a 2-year to 4.2451. The euro against the dollar, that currency pair negative for 2 consecutive weeks over the last couple of weeks and trying to bounce 108.19. So just getting its head above 108, Tom, in the last 24 hours or so.
Watching currencies, first thing I looked at today, as I mentioned, copper going south here, and I looked at renminbi, which is sustained at 7.03%. I looked at euro Swissy just to see the dynamic there, and the answer is between the euro dynamic and the yen dynamic, 138.10. It is that same collared feel that we talked to Goldman Sachs about in the equity market.
Breaking out above the top end of that range in the last week or so, the last couple of days. And Lisa, responsible for that breakout has just been a handful of these booming tech names.
Which really gets thrown into question a little bit with respect to the tensions between the U.S. and China that were thawing when President Biden called that silly balloon that China floated above the U.S. simply a roadblock in getting something. And then China came out and said that they were going to ban Micron from selling certain cybersecurity aspects, certain chips, because they did not pass a cybersecurity review. And Micron shares are down 4.4%, dragging down the entire sector with it. AMD down 1.4% in pre-market trading, Qualcomm 1% in NVIDIA, which reports earnings later today, down 0.8% after a 114% gain so far this year. To me, this is one of the key questions, right? I don't have a read on what's going on between the U.S. and China. The mood music coming out of G7 was some sort of hardening in terms of a line, in terms of the communique that they put out with respect to China and their anti-competitive practices. But then also you heard some different rhetoric from Biden. Then you heard the Micron issue. Are the Chinese officials going to start going after U.S. companies, international companies, in a more aggressive way? And how much does that change the picture for potential risk for even investors who are looking to buy or not buy?
And the confusion there, as you mentioned, is the president, because the president's comments were completely opposite of a lot of the rest of the zeitgeist.
Well, I think what Anne-Marie said about Mike Pyle was really important, which is you can say, okay, we're going to reduce competition, we're going to reduce some of the interlocking relationship between the U.S. and China, except that trade's at a record between the two nations. So how exactly are you going to do that without torpedoing the entire business model of a whole swath of U.S. companies? And that tension is really coming out in a rather, I don't know, I would say, hard to understand or less clear kind of message from the White House.
I think Western politicians have completely let the public down repeatedly over the last 2 decades on this issue. They've been sleepwalking into it. Sleepwalking into it. The idea that we had to have President Trump make this one of the big issues, and everyone came out and criticized him at the time. Have they changed the policy? Have the tariffs been rolled back?
Nope.
No.
Nope, they haven't. And actually, people are actually saying we need to harden the line. And that's one of the bipartisan agreements.
I think within the culture wars of America, this borders on a religious experience for a small group of people in America. And you see it, John, as we heard earlier, 20% of income comes from government, comes from Social Security, comes from the medical system. And where do those funds go? And it makes for a stew of Republican politics, which everybody has to deal with, including Speaker McCarthy.
But those two issues, Tom, you're right. Forget the mood music, forget the rhetoric, forget the tone. Follow the numbers. The trade relationship is massive. The Treasury cash balance is getting lower. They can talk up and down the debt talks all they want. They've got to get something done.
And within the mortgage rate going from 6.X% to 7.04%, which is a rich person's discussion, I would just look at the interest payments on our debt modeled out at $600 billion and modeled to do a double and even more out X number of years. All of a sudden, you know, we talk about cash, triple leveraged all cash fund. I could have 2/4 of a 2 and 20 payout on that. It's killing. I'm not doing
well.
No, the gross yield is not 15%, but it's like a 13.2%. That's before fees.
In all seriousness, I think people are really frustrated with this issue. They always conflate the debt ceiling issue with debt sustainability. And of course, there's a relationship, but ultimately the debt ceiling is just it's just something that's a real big distraction. They get to fight with each other. They get to follow their talking points. But ultimately, when they get into power, what happens? Very little. Very little happens. In fact, a whole lot happens, actually. The debt gets a whole lot bigger. And that's what's happened repeatedly from administration to administration, from administration to administration.
And the most important headline last week, buried, I think it was on Friday now, we were all brain dead, was John Williams of the New York Fed at the Laubach saying that R-star would stay low. If you have a low R-star, you have the convenience of growth saving the day. I mean, it's as simple as that. What do we got here on the debt?
Well, here's the take from Subhadra Rajappa of SocGen. We remain neutral on rates. Risk to yields are more balanced over the near term. A speedy resolution to the debt ceiling, although not our base case, would argue for modestly higher yields in the context of continued strength in the data. Now, TK, that's what we've had. I think, relatively speaking, we've had some decent data.
And what's so important here is first-order academics on statistics and central limit theory. Subhadra Rajappa joins us now without question on debt, our conversation of the day. Head of U.S. rate strategy at the derivative force, Societe Generale. Subhadra, I'm going to cut to the chase and go a little bit mathy here. In the equity markets, we talk about a collar. Maybe even in commodity markets, we talk about a collared trend of copper, live cattle, whatever. What is your world like when the 2-year yield is collared? How do you respond to a banded trade on yield in the derivative space?
So basically, as you pointed out, Tom, you have all yields across the curve in the Treasury market have been very range bound. You're looking at a range for 2 years around 4%, maybe 4.25 to 3.75. Same with 10-year as well. It's been in a very, very tight range. So really what that tells me, broadly speaking, is that there's really no strong conviction in the market on yields going either, monotonically higher or lower, broadly speaking, because of the fact that we're stuck between a rock and a hard place. In some respects, the data that we've gotten so far has been very, very strong. The consumer is resilient. The employment picture is relatively strong. Inflation is sticky. That would all argue for much higher yields from here on. But then you have the debt ceiling overhang, the regional banking crisis. as well as policy rates being high and sticky, that would argue for perhaps lower yields over the longer run. So we're kind of stuck in this range because of that.
When you are stuck, can you model out for higher, in the case of where we are in the range right now, can you model out a bet for higher yield and lower price?
It's hard because ultimately what you're looking at, especially in this environment, is for the Fed to pause. We're not talking about perhaps a pause, a skip, and then another hike later on this year, perhaps. All that means is that if policy is going to remain restrictive for the remainder of the year, then that would mean ultimately that you're going to see a slowdown in the economy. That's kind of what the Fed wants to achieve in order to bring down inflation. And that will ultimately mean lower yields. So, we have a recession penciled in for early 2024. The economy looks relatively robust up until that point on. But then once we do go into a recession, the Fed's going to have to cut rates. So the ultimate destination is perhaps for lower yields. The path between here and there is uncertain, given the fact that you have a lot of dynamics to get through over the short term as well as the medium term.
Subhadra, you mentioned the regional banking crisis is potentially helping to drive down inflation. What regional banking crisis? It seems like it's stabilized. We seem to swing between it not existing, not having ever percolated, and suddenly still being a full-blown issue that's going to help the Fed. Which is it?
So the regional banking crisis, broadly speaking, the headlines have definitely abated. You're seeing a little bit more stability in the banking sector. But broadly, the transmission mechanism from the regional banking crisis is going to come from the credit crunch or tighter credit conditions. It's going to come from a greater regulation, if you will, of both the smaller, mid-sized as well as the larger banks. That would, broadly speaking, would tighten credit conditions as we progress through the year. You're seeing mortgage rates start to rise. You're seeing real yields at around 1.4%. So that's also risen in the last few weeks. So broadly speaking, I think higher yields as well as tighter regulatory framework it should lead to tighter credit conditions over the remainder of the year. So yes, it might not be a crisis in the regional banking sector as of now, but the tighter credit conditions are here to stay.
Do you believe that right now that's going to perhaps constrain yields going forward, that that's really the key feature, the H8 reports that come out on Friday that determine really what that band is that yields can trade within?
Yeah, I think over the near term, yields are definitely constrained. You're probably going to see an environment where the 2-year is going to struggle to get past 4.25% because that would imply the market pricing out a lot of the cuts that are priced in, perhaps even starting to price in for hikes at upcoming meetings. That doesn't seem to be in the cards. Powell seems to be squarely in the camp of pausing rates, at least in the June meeting, and then taking it meeting by meeting thereafter. So in that sort of context, I think 2 years are going to struggle to rise meaningfully from here. And as far as the long end is concerned, it's much more pegged to the outlook for growth, not just in the U.S., but also globally. China has had a good year this year for growth. GDP is going to be positive. But again, for upcoming years, you're looking at a meaningful slowdown in not just U.S., but also global growth. That should kind of keep the long end pegged and then ultimately decline over the coming months as well as next year.
More Fed speak through today. Can't wait. Bullard Bostic Daily speaking throughout this morning and this afternoon. Subhadra, thank you. Subhadra Jaffa there of SocGen. This in overnight. Savita Subramaniam of Bank of America, 23 year-end price target. TK, you picked up on this one. 4,300. That's upgraded from 4K.
Up from 4K and up from a much more bearish take a number of months before. She's the best at ESG mathematics, and they've shifted to that's a bullish take from Bank of America, that adjustment.
She prefers the cyclicals and the equal-weighted S&P. We'll keep building on that. Joining us in a moment on the banks, Chris Marinac of Jenny Montgomery Scott from New York. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. President Biden and Republican House Speaker Kevin McCarthy are set to meet today for talks on averting a catastrophic U.S. default as time runs short and key differences remain. Negotiations have been whipsawed between progress and deadlock for days as the two sides simultaneously grapple for political advantage and a deal. Handpicked negotiators met Sunday evening at the U.S. Capitol. China has questioned the sincerity of the Biden administration as it pushes to resume high-level diplomatic talks with Beijing. A Chinese foreign ministry spokeswoman saying, quote, the U.S. side asks for communication on the one side, yet on the other suppresses and contains China by every possible means. President Biden says he expects ties with China to improve very shortly, dismissing an alleged spy balloon that caused a diplomatic spat earlier this year as, quote, silly. SpaceX launched 4 private astronauts en route to the International Space Station, including the first woman from Saudi Arabia to travel to space. The crew lifted off atop a Falcon 9 rocket Sunday evening from the Kennedy Space Center in Florida. The mission, operated by Axiom Space, is the second of 4 human spaceflight launches that SpaceX is set to handle for the company. Axiom has plans to build its own private space station in the future. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
It's very hard for banks to compete with deposits when money market funds are giving you, 5%, 5.25%. And if the Fed continues to raise rates, I think that gap continues to be wide. So I think the regional banks are still in trouble, not so much because of massive outflows, but their entire business model, if they're funding from the Fed at 5%, it's very hard to fund your assets, which you bought at 2%.
Priya Misra of TD Securities ahead of global rates on interest rate strategy and looking ahead to the Fed talk through this morning and beyond into Fed minutes on Wednesday. TK's just overwhelmed by Bullard, Bostic and Daly speaking a little bit later.
This is like the minutes.
Logan tomorrow. Waller on Wednesday, just ahead of those Fed minutes. All exciting stuff. In the equity market, totally unchanged. That's exciting too. On the S&P 500, we go absolutely nowhere. We've been going somewhere finally, though. A break of 4,200 on the S&P 500. That really tightly, well-defined trading range of the year so far. Breaks to the upside. I remember Anastasia Amoroso of iCapital, Tom, saying to us a few months ago that that's how she expected this to break, and that's basically what's materialized in the last week.
The bulls got to take a victory lap. Everybody's rationalized this and up. I understand we're at a collar, et cetera, and there's 4 stocks leading the way, whatever. But the people that said have courage to be in the markets, they look like geniuses on this May Day.
Totally. The bearish view might make a whole lot of sense, but it's not working. You heard it again this morning from Mike Wilson, Morgan Stanley.
Well,
JP Morgan. I imagine you hear it from Marko Kolanovic later from JP Morgan too.
Just wait.
Well, it sounds good. Just wait, sure. But you've had 6 months of missing out on a pretty decent rally.
What was that expression again? That if you're late, you're wrong? That basically,
if you're late, you're
well,
wrong.
I think the emotion FOMO is too simplistic. It's not about FOMO. It's about.
It's not aimed at you, Bramo. It's not personal.
You're like, if you're late, it's wrong.
You know, you've missed it.
I understood. Yeah.
A lot of people did. They said the first 6 months of this year dip, and then we were going to rip, except we ripped
The
up
technical
front.
reality of a bear market is you get lots of what are called intermediate bull market trends. Is this an intermediate bull within a long-term bear market? And then, there's a lot of different opinions on that. That's all there is to it. Christopher Marinac joins us now, director of golf at Janney Montgomery Scott. He's not here to talk bank stocks. He's here to talk. We saw Oak Hill in the PGA this weekend, and you live next door to Augusta as well. Very cool. I mean, give us a little vignette here after this spectacular weekend of golf, including a hole-in-one by the PGA Pro from California. Give us a picture of your Augusta. What's it look like?
Oh, it's the prettiest place on earth, but it's also a golf course that actually gets totally taken apart in the summertime. So when they close next week, they'll be closed for 3-4 months, and they'll take the entire place apart and redo the greens, redo a lot of things, certainly fix up a few trees that fell back in April. But it's an incredible piece of property.
It may be a place to relax when you're dealing with the bank stocks as well. Are you at any point a master's relaxation about the banking crisis, or is it still very vivid on a Monday morning?
Well, it's early innings. We have a lot to go. I mean, we still have a recession to find and then real estate to work through. And the banks, I think, will continue to make money throughout this whole journey, but they certainly have issues to deal with the next 3 years.
It seems like the move is toward greater capital requirements. We're hearing that from Neil Kashkari today, and we got a little hint of that today from the JP Morgan Investor Day. What did we hear from them?
Well, JP Morgan talks about their fortress balance sheet all the time. So, their slides are no different this morning about that. I think their leadership position in the banking industry is second to none, and so they're going to continue to remind everybody that capital is king. The stress tests come out in about a month, and my sense is the Fed's going to pass most, if not all, of the banks, but they're going to politely ask for more comfort capital and require banks to raise additional equity.
Which banks?
I think the banks in the stress test, and then that will get pushed down to regional banks. So, pretty much the rules work that anything that happens at the top 20 banks will get pushed down to the next 20 and the next 20. So it kind of falls from the top down.
We talk about the potential for just profitability constraints within some of the regional banks. How much will the profitability be further constrained and their lending mechanisms be curtailed if there is greater capital requirements foisted on them by the Fed?
Well, capital is going to naturally improve for the banks because of retained earnings, and I think there's a slight comeback on their equity securities just because you have natural amortization and payoffs of their HTM and available for sale securities. The challenge is going to be that raising additional capital to cover what could be a future credit cycle in 24 and 25. That's why the capital, I think, goes up. We still have those unrealized losses that are not going to go to zero. They're just going to get incrementally better.
Should people buy individual stocks, ETFs, BKX? What's the intelligent way to play this 3 years out?
Well, I think a basket of stocks across all market caps makes sense. It's not just the large cap. I think looking at mid cap and small community banks makes a bunch of sense. A lot of those are even cheaper than the regional banks that have been hit. My sense is that there is a real opportunity in these companies, many of which are trading below tangible book value, and tangible book value is growing.
Every now and again, TK and I take a stroll up Park Avenue. Bramo doesn't like to be with us publicly. And when T and I walk up...
This is pretty public, guys.
It's true.
Just saying.
I mean, like on air, but not outside of the building. We go up Park Avenue and we go past the First Republic. On the next corner, the next block, is a Chase private client, almost immediately.
Sure.
And on those screens in First Republic, they're playing Bloomberg. And I often always think of them because, right now we're talking about them and they're looking up at those screens and they're watching us talk about them. Can you tell me what's going to happen with those branches? Does anyone know?
I think they'll stay the same for probably a year or two and quietly change gears, maybe become a second JP Morgan office, maybe they'll become something else. Most likely it's going to be a slow play.
You don't think they're just going to immediately come out with a knife and just cut all these branches and close them?
I don't think so. They gave expense guidance this morning that's the same that they had before, excluding the FRC.
We heard from Janet Yellen that there is going to be more consolidation akin to that First Republic getting acquired by JP Morgan. How much more, and is JP Morgan still in the business of acquiring acquiring, or is it going to be sort of the other Bank of America, the other big banks?
I think it might be nothing, actually. I think that the consolidation may have already happened because you have 3 banks that failed in March and April, and that represents about 4% of the assets for those big regional banks. You know, the interesting thing to me is if you look at the top 25 banks in the country, they represent 2/3 of the assets in the FDIC deposit. So why do we need consolidation when you already have 2/3 held there? So I think the consolidation may be greater mid-size and smaller.
So every analyst who comes on talks about the regional banking crisis as something that's going to tighten credit conditions and actually help the Fed. Are you pushing back and saying that's not really the case because it's over?
Well, I'm not sure the crisis really ever happened. I think we had mishaps in the month of March with these failed banks, but largely those were their own doing. I think the rest of the contagion that's been limited to PacWest, Western Alliance, both of which seem to be stabilizing. PacWest has positive news out this morning on asset sales. I think that the rest of the industry is marching ahead. You know, we have seen deposit outflows in the industry for sure, and those may continue just because interest rates need to catch up for depositors. But most of these banks are lending money, making a profit, and marching forward. So I think there is tighter credit anyways, but it's not as bad and as negative as I think headlines have suggested.
The heritage of Jenny Montgomery Scott is Philadelphia, the mid-Atlantic states, and all the roll-up there that happened 30, 40 years ago in banking. When do the regionals finally act and consolidate? Waiting and waiting and waiting and waiting. When do they finally say enough?
Well, you could see 2 or 3 mergers the next couple of years of those regional banks, but I'm not sure it's going to be that often. I really think it's going to be a lot less than we anticipate. The Fed has to really change gears at the examiner level to push these mergers. The last 2 years, mergers have taken forever to close, and a handful of them terminated. Just ask TD.
That's a people thing, the examiners?
Sure, absolutely.
Interesting.
Masters tickets, have we nailed that down?
Yeah, we had. Chris is our new friend.
Okay, good.
The odds, according to Golf Digest, thank you, Simon, for this, to garner Masters tickets is a 1 in 200
1 in
odds.
200. That's through the lottery.
The lottery, whatever they have.
Okay.
Yeah, I
just have to
applied last year and went
Got to
down
know
in
people,
flames.
Bramo. Do you know people?
No.
No,
Okay.
we know Christopher Marinac.
But Chris knows people.
He knows people that we know.
That's good to know.
He nods.
Well, it's
yes.
good to know you, Chris. Thanks for being with us. Chris Marinac, Jenny Montgomery Scott, we'll be in touch.
Our new best friend.
Early in Q1 next year, going into the Masters. Some hot tickets at Monte Carlo, Tom. You seen the Monaco F1
Yeah,
tickets?
we've got to remember, John, this is off these horrific floods 2 weeks ago in Italy. Really, really damaging and way too much death floods. So it's somewhat of a celebration of F1 to restart today. And, you know, I think we've got to keep an American heritage here to Bloomberg surveillance, which means, you know, Grand Banks 85 in the harbor.
Is that a nice boat?
Good American trawler. Yeah, it's American.
Does that fit in well in Monaco?
It would be like, who are they? Because it's American. It's got an American line to it. It's got it's a different line. Than,
Okay, well, I'll have to take a look at that.
Do you know that Monaco has the highest top 1 percentile of earners?
I saw that. We did a Bloomberg story on it.
We did, and it's like, what is it, like $19 million of income?
What does it take to be in the top 1%?
Yeah. It was something
Is it
insane in Monaco.
John, seriously,
more than you'll ever have.
Is it the most narrow streets all year?
Oh, for the racing?
Yeah, for the races.
Yeah, classic street race. Classic.
I remember being afraid of the classic James Garner movie.
That's very
like
cool.
Afraid of it.
There's a great scene, 2006, Kimi Räikkönen driving for McLaren. Car blows up, gets out, and he goes to his yacht and watches the rest of the race from his yacht. It's fantastic.
Yeah, but
That's
you've
what I
done
did.
that on surveillance.
You know, that's a different life, isn't it? I mean, that's just a different life. Lisa Hornby of Schroders on the Fed coming up.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yangwang yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody? The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful. In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction where they invest if they invest for the right reasons, just keep at it.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
There's this kind of tension in the market.
It is a very, very narrow advance in the stock market.
There is a risk here of people really capitulating to the upside.
The market's not pricing in a recession, far from it. I think the market's pricing in normalization.
We're now talking about investing for 2024, looking over the horizon of the slowing economy to what the market will look like next year. And that's really what's going on in the markets right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on Merger Monday. Thank you for being with us on radio and television. And when there's stress out there, what do? You mate. Mizuho of Japan takes out Greenhill of New York. This is Scott Bach and Mark Lasky, and this is what we're going to see the rest of the year. I mean, the merging here.
I can't.
We're going to see it the rest of the year.
When there's stress out there, you mate.
That's what we're doing. I'm sorry. It's a great roll-up here, and you see it with Greenhill being taken out by Mizuho.
Okay, I'm going to save this. I'm going to go through these headlines. Not the first US-Japan banking tie-up alliance, if you want to call it that.
Yeah.
Reporting from Shinali Basak, they're forging further into US investment banking through this deal for Greenhill. We've got a price, Tom? $15 a share.
$15 a share.
$15 a share. So $550 million, including debt.
Yeah, what's interesting to me is that Scott Bach, ex-Morgan Stanley, and Mark Lasky, who was at Goldman Sachs, and it's another one of these bolt-ons. And you say, well, why is this happening? And I'm going to go back to the heart of the matter that we talk on each day. All of a sudden, money costs something, and that is a catalyst for mergers.
It's also a catalyst for being too big to fail. And this, to me, is sort of the interesting emergence from this not crisis or whatever you want to call it. What you have is you get profitability from being bigger. And so after decades of people saying banks should be smaller, banks should be more diversified, all of a sudden, bigger banks are more successful, bigger companies are more successful, and that's really what you're going to see more and more of.
One more deal across the Bloomberg, Tom. Chevron to buy PDC Energy, $72 a share, all-stock deal. That's just crossed the wire now.
And it's important here. This is not the zombie roll-up. I mean, these are companies that are really quite good. But again, it's this urge for scale that Lisa mentions. I believe we were doing this 7 days ago, Merger Monday last week, where there were 2 transactions. I believe the sum was $38 billion between the two. So it's in the air.
There's some confidence to get deals done. And Tom, overall, more broadly, the economic data is looking pretty resilient relative to expectations, which is why I think we've changed the language around June, away from pause to perhaps skip, with consideration that maybe they come back into the mix and hike rates again.
I can just see Tom's face as you say this.
Please stop, Bram. I'm just trying to stay serious after the way you opened that program.
In times of stress, you made. I mean, basically,
that's what they're doing. I mean, you're going to see much more of this.
Still don't know what's making us laugh, do you? All right, carry on.
4.26% of the 2-year yield. And I'd also point out, John, with the equity markets where they are, the bears, you mentioned a couple hours ago, Mike Wilson and others, restructuring a bear market view where others are capitulating into the optimism you see from Greenhill and Mizuho as they made.
An all-time classic, that was. Let's get to the price section on the S&P 500. Equity futures on the S&P. Let's keep it together. Positive by 0.1%, just about. Yields higher by, let's call it a single basis point, Tom. 368 on a 10-year.
And also I'd notice as well the dollar here churning. John, you mentioned earlier 108.22 on euro. It's not giving us much information, but it's something worth watching. And commodities, John, we've under-chatted. The answer is commodities are persistently weaker, and we're over the weekend.
I've been talking to the team at John Hancock about this. They're not all behind that cyclical story. So let's just quickly go back, rewind a couple of steps. Savita Subramanian's upgraded the outlook for the S&P 500, much more constructive on the equal weight S&P. So you strip out the muscle of big tech. Likes the idea of the cyclicals picking up again. Are we getting that kind of validation from the commodity market from places like copper right now for global cyclical impulse? I would say no.
No,
not seeing that.
Let's go to a guest here right now to give us perspective here with all the different news flow. We have Lisa Hornby's head of U.S. multi-sector fixed income at Schroders. The yield move that we have lifted up, does it take us up to a collar edge, yields up to resistance, or is there something going on here, Lisa, that's original?
You know, I think the market is still flirting with this idea of, is there a path where things can actually be okay? And certainly resolution on the debt ceiling, which was last week's optimism or cause for optimism, is a step towards that path. Of course, I think we'll have some fits and starts between now and then, and I don't think we'll see the highest end of the 10-year range where the peaks that we got to last year. But I think there could be some tactical trading opportunity here for sure.
What are you doing on duration? We hardly touched on it this morning. Not so much the price move or yield move, but the bet you place in maturity.
Yeah, you know, I think duration, look, the outlook for bonds in our view this year has been compelling. I think 10 years, we're probably looking at a range of 325 to 375. So we're getting towards that upper band. We like tactically trading, but erring towards being long because our view is for economic deterioration. It's kind of a slow burn, but I think that's where we're headed. And so we want to come out the other side of this long, but understanding this is going to be a volatile market as it really has been for the last 4 or 5 months.
Lisa, where are you seeing that signs of economic deterioration at the moment?
So certainly a slow grind, but we are starting to see it on the consumer side. It's obviously very gradual, but we have seen credit card balances tick up. We have seen on the auto loan side, now really across the FICO spectrum, a bit of deterioration. Obviously, jobs still remain very, very resilient. One of the things we're watching, though, closely is small businesses. Small business surveys have really deteriorated over the last, I want to say more than a year. And that deterioration, in our view, is probably set to increase as credit conditions tighten for these guys, particularly in light of what's going on the regional banking side. So that's where we're focused. I mean, we have to remember small businesses in the U.S. employ a very large percentage of the population. We spend a lot of time talking about the GEs of the world, but probably 90% of businesses in the U.S. are small to mid-size. So their outlook is pretty important, and it's not particularly compelling when you look at the data.
We just had Chris Marinac on over from Janney Montgomery Scott, and he was talking about the regional banking crisis that wasn't. And so I wanted to get your sense of what is happening in terms of the credit tightening. He said that regional banks are in a much better position than people assume. They're not constraining their lending mechanisms all that much. Do you see something different, or do you think it just hasn't happened yet, but just wait and it will?
I think it's a bit of a slow burn, right? The cost of capital has gone up. These regional banks are under increased scrutiny. I think there will be more focus on balance sheet preservation and the type of loan making that they're doing. And I think certain pockets of the economy will see a little bit more stress as a result of that, and make it a bit harder to access capital. I mean, Tom said it before while I was listening in earlier. The cost of capital has risen, and that poses an issue. And it's supposed to pose an issue, right? The Fed is doing this intentionally to try and slow economic growth, and they're doing it, but it takes some time.
Given how resilient the economy has been, and given that we haven't really seen the credit stress materialize in a way as significant as many people had expected at this point, what is the risk that the Fed's going to have to tighten further? It's going to have to hike again, perhaps even in June, because maybe the constraint isn't that great from the regional banks just yet, and that it will have to be this slow burn that goes on for a while.
Yeah, I mean, the market is certainly flirting with that, right? We've seen the probability of a Fed hike at the next meeting move, vary between 25 and 40%. If we get a debt ceiling resolution in the near term, I wouldn't be surprised to see that move higher. I think the Fed wants to be cautious. I mean, if you listen to Powell's comments last week, he didn't explicitly suggest a pause here, but he did allude to the fact that, hey, we've done a lot. We could potentially be patient and see what the impact is. I mean, they are breaking things, right? There are more, look at the move index and where it's been over the last year versus the previous several years. Things are starting to percolate in the background, and we have had several banks now fail. I don't know that story is completely played out. I think that they realize that there are now some risks out there that are becoming a bit more serious. And so all else equal, I'm sure they would prefer to pause, but we have a lot of data between now and the middle of June, their next meeting. So we'll have to wait and see.
Well, let's just finish there, Lisa. Clearly, you're not going to keep on hiking until you see 2%. Do you think we've seen sufficient evidence right now that they are sufficiently restrictive? Or is this a guess based on the cumulative tightening that they've already delivered?
I think it's a great question. My sense is they've probably done enough. They might go a little bit further because they're looking at data on a lag. If we could fast forward 6 months from now, I suspect that inflation will continue to slow, and that they will be closer to their targets, and growth will be starting to roll over in a more serious way. But if we get another 5.5% inflation print, that all bets are off. So I think, unfortunately, the way monetary policy works is with a lag. And so they'll react to the data as it comes in rather than, 6 months or 12 months from now, trying to see the bigger picture.
Hey, Lisa, this was great. Lisa Hornby there, Schroders. Appreciate it, as always. Tom, I think we often underplay this, just how much of an educated guess the Fed has taken at the moment. This isn't science.
No, it's not science, it's theory. And the question is the theory there? I've been moving books around at home, and you look at the textbooks at home, how much of this is in the textbooks? I got too many people telling me it's in the textbooks. I'm like, no, it's not. We're out of a pandemic. The dynamics are there, including 3 tranches of Biden stimulus and Trump stimulus. And, the cliche is it's original territory. It is.
Which is the reason why data dependency is a little frustrating for all of us, because how do you depend on data that is giving an unreliable and backward-looking metric of something that you don't really understand the parameters of? And I think that is the frustration with the Fed speak, because they're basically in this fishbowl without being able to see outside and try and give you guidance when we're all in the fishbowl.
Data dependence, that phrase kills me. It's the worst.
Can we get back to mating?
Of course.
I looked at Greenhill, and I haven't followed it very much, GHL, but I took a moving average study from 2010, John, when they were enjoying $80 per share.
Yeah.
They're down to 82% with a $15 takeout from the glory days.
Would you like to share that wisdom with our audience one more time? What happens when you get stressed?
Just, you have to mate. I mean, that's all there is to it. You got to, the dinosaurs got to go out there and they got to get, they've got to do it. We're up 114% now, which is great.
Okay, nice.
But down from an 80 share price a long, long time ago and far away.
So we've gone from the Golf Network to Animal Planet.
It's like Mutual of Omaha.
Yeah.
Wild Kingdom.
Progress.
Evolution.
Michael O'Leary, CEO of Ryanair, in the studio up next.
Inside the mind of Tom Keene, keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Bloomberg has learned Mizuho Financial Group is forging further into its U.S. investment banking through a deal to buy Greenhill. Now, the Japanese banking giant agreed to buy Greenhill for $15 a share in an all-cash transaction, which values the firm at $550 million, including debt. Now, the firm said that Monday in a statement. The lender will retain Greenhill's leaders, including Chief Executive Officer Scott Bach. Ford CEO is pushing the company's plan to lift annual electric vehicle output for 2 million by the end of 2026 at an investor event in Michigan. Jim Farley tells Bloomberg the company is taking the fight in EVs to Tesla.
They've had the market to themselves. They had a big head start, kind of like what we do on Pro. And now they're seeing a lot more pressure, obviously. Where we compete really in EV, pickup trucks, 3-row crossovers that we're going to show people today, and the commercial vehicle, EV commercial vehicles, we don't see as much price, competition because there's not as many vehicles choices there.
You can watch Bloomberg's full interview with Ford CEO Jim Farley on the terminal and throughout the day on Bloomberg TV and radio. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Live from New York City this morning. Good morning to you and welcome to the program. This Monday morning, equities just about turning positive in the last 10 minutes on the S&P 500. Equity futures on the S&P positive now by 0.06%. And we'll see, TK, if we can add some weight to the rally last week on both the S&P 500 and on the NASDAQ too.
We're going to have to see. I mean, the market's moving, and I'm sorry, I see a little lift here, and to me, John, it lifted off of the takeout news. 1, 2, 3, 4 takeouts, including Chevron.
Is Chevron getting a deal done?
You know, tapes changed here a little bit.
Mizuho getting a deal done?
No question about it. I mean, that's just all there is to it. John, you know, I'm flustered. I'm a father in America.
What are you researching?
And I'm researching, you know, the middle child goes over to Europe, and you realize that they're in school so that on the weekends they can travel places and have a life I never had. And you have the typical dad panic because in America to fly from Cincinnati to Fargo, South Dakota, North Dakota is a ton of money. How about Edinburgh to Dublin, $26.63?
That's great, isn't it?
That's just one way. I mean,
Ryanair.
You know, Ryanair. I mean, you're all in $52, $60.
Tom, I used to fly to Bergamo out of maybe East Midlands or Stansted for 15 quid, £15.
Why don't you bring in the man
the man who made it happen is responsible
for
my vacations in Europe as a child. Michael O'Leary, CEO of Ryanair, joins us right now. Michael, great to see you in New York. Good to see you, mate, as always.
$15.
It's not bad, is it? So, Michael, tell me this. Is that the future still? Or have things changed?
It is the future, and things are changing. I mean, I think, you know, we've ordered another 300 aircraft from Boeing 2 weeks ago. So, you know, we're going to grow from 149 million passengers pre-COVID to 300 million passengers by the early 2030s. So there's still lots of growth for Ryanair. But growth is getting easier in Europe. The market has consolidated post-COVID. Capacity has come out. I mean, we're looking across Europe this summer where we're operating 25% more seat capacity than we had pre-COVID. But the rest of the market's only operating at about 90%. So we're taking huge amounts of market share from everybody else. We're well hedged on fuel. We're offering really low airfares. But those low airfares are up a bit. Like, we expect our lowest airfare to rise probably 5-10% a year for the next couple of years because of this capacity constraint. And with the manufacturer's challenge, Boeing and Airbus, huge backlog on orders, can't increase monthly production because of supply chain difficulties for the next 4 or 5 years. I think you're looking at a European marketplace that will now copy some of America in the last decade, stable capacity and more reasonable pricing going forward.
Is that good for you and bad for the people travelling?
I think it's good for us. It's also good for the people travelling. But the challenge is, if you look at the German market this year, for example, Lufthansa, which was bailed out by the German government to the tune of 13 billion during COVID, they've only restored 80% of their pre-COVID capacity. Airfares in Germany have doubled this year over last year. So, you know, German consumers are being stiffed by their national champion, and they're increasingly turning to us because we have capacity growth. I'm taking 50 aircraft a year from Boeing. Because we have capacity growth, we can keep fares down. But I have no doubt in my mind that one of the big drivers of Ryanair's growth the next couple of years is going to be the incumbent legacy carriers really driving airfares much higher in Europe than they are in the US.
Are you willing to then just have a commensurate increase in your price, just perhaps less?
Absolutely not, Lisa. We're going to keep growing capacity. We will remain load factor active, yield passive. We intend to take huge amounts of market share from every incumbent in Europe as we grow our share in Europe from about 20% now to about 33% in the early 2030s.
People talk about the travel boom that has really supported services globally as being a bit of YOLO. You only live once after the pandemic. Get out there and travel. And if you're not dealing necessarily with the business segment as much, how confident are you that that's going to continue in perpetuity?
Perpetuity is a long time. I mean, it's too long for my horizon. Next 5 years, it's going to continue. There's a couple of fundamentals in Europe. One, we're seeing very strong business growth. I mean, businesses are flying around Europe, particularly to kind of Eastern Europe, Morocco, Portugal, repairing supply chains that they can no longer depend on Asia. And they're looking to find cheap manufacturing in Morocco, Portugal, Poland, Romania. We're the biggest airlines in those markets. So we're seeing a very strong recovery in our business travel. I think people who were locked up for 2.5 years are going back traveling, and that's not a short-term phenomenon. Travel increasingly. I think what really surprises me about the moment, for all the negative coverage of higher energy prices, price inflation, there's still fundamentally full employment in Europe. People are getting paychecks at the end of every month, and what they do is they go traveling. Leisure time is rising. You have kids who are all over Europe. I mean, when I grew up in the 70s and 80s, as my children keep reminding me, that was the last century, we went around Europe by train.
Thank you.
You know, you'd interrailing. Now they go around Europe on Ryanair. This summer, huge US flows into Europe. The Asian market is recovering, but because only 90% of the pre-COVID capacity has been restored, demand is strong and pricing is strong. And I see no reason why that won't continue for a 4 or 5 year period. Now, there'll be curveballs, COVID, Ukraine invasions, things like that will throw us off course. But the underlying fundamentals are very strong. Demand for travel is strong, and supply is constrained by aircraft manufacturers. There's a cap on what they can build and how fast they can increase production.
I've got an aerospace team with a lot of really smart questions. Here's the only question our listeners and viewers care about. It looks like the U.S. airfares are a complete scam. I looked at a quick eyeball, $60, $70 round trip on Ryanair versus $300 in the same flight in America, roughly. And I look at the margin you're making, 12 cents modeled on the dollar versus 6, 7 cents at, say, Kirby's wonderful United Airlines. Why can't America get this right? Why aren't you in America?
One, because there's so much growth for us in Europe. Why would I want to go to America when we can deploy all of this growth in Europe? And Europe is still fundamentally underexploited. Europe is moving towards consolidation. I think the American airlines have slightly overplayed it. You know, we look at Southwest, and, you know, Southwest was a kind of heroic model for us when we first started this 30 years ago. But Southwest is no longer fundamentally a low-cost airline. You know, its average ticket price is $110, $120 a seat. My average ticket price last year was 40 euros a seat. So I think, you know, more needs to be done there. More capacity needs to be found in the American industry. But the challenge is going to be for all of us, because Boeing and Airbus can't fundamentally increase their production rates. This industry is going to be challenged for the next 4 or 5 years. And I think we have to be careful not to repeat what's happening in the States. We don't want to push pricing too high. And that's, I think, why our 300 aircraft order with Boeing is so key to keeping prices low and people traveling across Europe for the next decade.
You could buy some capacity. You mentioned consolidation. You interested in that?
No. I mean, you know, it's just I'm buying somebody else's problems. Great. But I'm very happy in Europe to see Lufthansa buy Alitalia. Let's see IAG buy TAP. I bet you are. You know, consolidate away. And you'll need to consolidate because none of you are going to are able to compete with Ryanair because we have much lower costs than you, we have much lower fares than you. So you may as well
great
consolidate.
Balance sheet too. So if you don't want to play the consolidation game, you're sitting there with a great balance sheet. No debt right now, right?
No, we're paying debt down aggressively.
Paying it down.
We've no net debt. We went zero net cash.
No net debt. Fantastic. Yeah. Okay, capital returns?
I think it's coming, just not yet. I mean, we're paying down debt at the moment. I've paid 2 bonds this year, 1.5 billion of debt. I've only got about 2 billion of debt left. I paid that all down in 2025 and 26. I'm spending about just over 2.5 billion a year in capex, which I'm funding out of internally generated cash flow. And once we get through that, I think maybe next year, if we have another strong year and we have significant net cash balances, then we'll return those to shareholders.
Ryanair 26% debt, UAL 70% debt.
It's a big difference, isn't it? Just a massive difference. This was fun, Michael. Got to do this more often.
We do. I got to come back to the States more often. You see,
can you bring your damn airline to the States? Lisa and I are getting absolutely crushed.
I want to know what the
airfares.
secret is. I mean, why some people can offer $40 or 40 euros.
Double it, 80, 90. I mean, double it, 80, 90 compared to 300. It's ridiculous.
You look through history, the Irish have always been, you know, we've been transport pioneers. We built the roads, we built the railways, and now we're building the air. We're going to dominate the skies across Europe. Come to Europe for low fares. Don't bother holidaying in the States.
You know, when you're back, we need to talk about a business traveller. I do wonder what's going to happen here. I remember EasyJet made a big transition years ago to get the business traveller, and I wonder if your cabin's going to change at all in years to come.
Absolutely not.
It's just going to remain the same. You're going to keep the same thing.
Business travel, what's different about people keep confusing short haul and long haul. What's different in short haul is nobody will pay a premium for business travel. Business just want on-time, affordable, safe transport. They want to get there. Long haul, 20% of the market will still pay a ludicrous premium on long haul, which is why long haul and short haul is different. And we intend to continue to grow very strongly in Europe with a huge growth in business travel as well as leisure travel out over the next decade. And I can only do that with my beloved aircraft partners, Boeing, who will now send me 400 aircraft over the next 8 years.
No more sales pitch. I don't think they fly to Monte Carlo.
We fly to Nice and Marseille.
There we drive
across the border.
From New York City. Michael, thank you. This was great. Thank you, buddy. This is Bloomberg.
for the first, call it 18 years of Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg Savannah's good morning, everyone. John Farrell getting ready for the next hour. Lisa Bramlett and I holding court here. We're going to get some good conversation on the market right now. There are many names at J.P. Morgan. Some of them mentioned by Shonali Basak earlier. Congratulations, Shonali, on her reporting on Greenhill being taken out by Mizuho. The big pop, 100% lift in the stock there to get it to $15 a share. But the J.P. Morgan conference goes on now. Lisa, signs of deterioration in economy.
No signs.
What are they supposed to say?
No signs of deterioration in their net interest income. In fact, they upgraded it to $84 billion from the expected $81 billion. So they are making more money. And here's the question, right? As they look out, how much are they going to consolidate business at a time where there is this pressure, with the JP Morgan CFO saying that they do expect the system-wide deposit outflows to continue from them? Maybe less than perhaps at some of the smaller institutions.
I would suggest managing the message here. And the message here, and an important data check this morning, is there's a little bit of a bid to the market. We were red earlier, now green on the screen. Futures up 4, Dow futures up 32. The VIX, not a 16 level, or dare I say the 15 print we saw in the enthusiasm Friday, but 17.08 to reset here. In the yield is what I'm really looking at. And Lisa, I'm sorry, the 2-year yield rounded up 4.28%. Can we begin to model out a 4.30% 2-year yield on the way to 4.50? That would be game changing.
I don't feel any momentum anywhere in the macro trading. I see it in the micro stories, but on the macro side, everyone's gone to sleep waiting for the debt ceiling debate to be over, waiting for some sort of new catalyst. Otherwise, why is anyone going to get really jazzed about anything and have too much conviction about one way or another?
And conviction is going to be, as we mentioned earlier, in the job report and critically the inflation report before the June Fed meeting. I think one other insight here that we can say is the whole theme is about collars, about being within a range, somewhere above support, somewhere beneath resistance, depending on what you look at. Not in copper. Copper is not a collared trade. Copper is a weaker trade. Other than that, a lot of collars out there.
Is that a macro story, or is that a China reopening story?
Well, the partition, this is really important, folks. We'll do a lot more on this through the week. On China, I would suggest it's a domestic study versus a foreign study for China. And it looks like foreign maybe isn't happening, even though the domestic economy is doing okay. I'm almost guessing there.
That's what some people say.
You know,
and so at what point, how does that factor into the commodity sector, perhaps, more than a broader base deterioration?
7.03 yuan per dollar shows a renminbi weakness we've seen the last number of days. Here's what we're going to do. We're going to plunge into it right now. He's chief market strategist at Jones Trading, writing an afternoon letter that gets a huge attention. Michael O'Rourke joins us right now. Michael, what are you going to look for today to write this evening? What is the key thing you're focused on a Monday?
Well, obviously, it's the debt limit negotiations. Fits and starts is the best way to describe this process. And there's a lot of optimism Thursday, and obviously a lot of positive comments from both sides, only to call it quits. I think it was around 10 a.m., 10:30 a.m. Friday morning, so everyone could enjoy their weekend. So obviously negotiations will resume today, and I think the entire market's in this holding pattern, waiting for this situation to show some real progress.
And yet you and I have seen the market walk away from the bears. What is the character of the day-by-day? Grind is almost too much of a negative tone. The lift to the market that we see, what is that character?
So you mentioned ranges a few minutes ago, and the S&P 500 had been this 4050 to 4175, 4200 range, and now we're pushing above that 4200. Yeah, the Nasdaq 100 make new 52-week highs last week. A bunch of I call it, the big mega cap stocks. I've gotten to call them the Magnificent Seven, who are driving the S&P 500 gains for the year. Four of them made new 52-week highs last week. And again, this is people checking out of the market. And I think one thing that's definitely missed out there is that about 30% of the S&P 500 names are owned by passive shareholders, indexes, ETFs, and things like that they're not sellers. And we've pumped so much liquidity in the market over the past several years that the pricing mechanism doesn't react, as efficiently as it once did. It's very slow to react, actually. So what we're seeing now is we're seeing this drift higher because people have checked out, and there is not much going on the tape, and you just have the structural bid that underlies the market. And even though there's not a lot of positives, if any positives out there in the market, we're seeing just multiple expansion as we drift up. And I think you need more engagement by active investors to get real pricing out there. And until we get the debt ceiling resolved or make some real progress here, you don't see that. So you just have this slow drift higher.
Do you think that there will be some sort of catalyst to get the market not just to tread water the way it has been if the debt ceiling debate gets resolved?
Well, I think then you start shifting focus back to inflation, where the economy's at. As Tom mentioned, we'll have PC inflation at the end of the week. I don't expect much improvement there because CPI, a couple of weeks ago did not show any improvement. But nonetheless, it seems to be we're set for the Fed to pause in June, and I would expect that to be the case. But as far as the economic slowdown that everyone's been expecting, including myself, it's taken much longer to play out, and we're still sitting here with matching 6-decade lows in unemployment. So we're gonna shift back to the inflation debate, and that higher for longer, I think, is going to be even longer than anyone expected when we started this process, over a year ago.
You sound frustrated a bit, Michael, and you're not alone with respect to trying to understand how to play a macro story at a time of just such uncertainty. Is there a corollary for this moment?
A corollary? I can't think of a corollary because I do think the liquidity of the easy monetary policy, negative real Fed funds rate for most of the past 15 years all plays into this. I mean, it's funny. You were talking about the banks earlier, and everyone, people are talking about more bank capital and things like that. I mean, one of the biggest players here was the Federal Reserve pumping so much liquidity in the system that bank deposits went up by $5 trillion or 30% in the span of 2 years, 35%. Those banks had to put money to work, and surprise, surprise, they made some bad investments. So there's two sides to this. And again, this is just something that's going to take a while to unwind.
Michael, what's the value of cash here? And do you observe a lot of cash out there?
I don't observe a lot of cash, but you talked about that 2-year yielding 4.3%. That, I think, is a very attractive investment in this environment if you want to be more defensive. Again, we're not seeing a lot of great, earnings season was a little better than expected, but earnings are going to be down year over year. So if you don't want to bet on multiple expansion, you can go for the safety there. And again, we're entering this period of a positive real Fed funds rate after 15 years of mostly negative one. That should lead to a more challenging environment the second half of the year, early next year.
Michael, thank you. Michael O'Rourke with us at Jones Trading here on a busy Monday morning. Looking at the markets here, and again, highs of the day, a little bit of a lift, constructive. Futures up 4 right now. Lisa, Merger Monday. I think we had Merger Monday last time. A little different character. That was, my recollection, that was a huge mining deal in Australia. Like somebody bought all the gold that's out there. Yeah. And today it's finance guys in an oil company here or there.
The finance one is interesting just simply because of some of the change that we've seen at the heads of a number of banks and financial firms, whether it's the likes of Morgan Stanley on Friday, whether it's the likes of what we saw with Peter Orszag going in and stepping up over on the private equity space. Mizuho, though, buying Greenhill, really interesting as scale seems to matter that much more.
It's going to be interesting to see, and the heritage here out of the great financial crisis is fascinating. I remember the day that Jason Trennert left Ed Hyman's shop, Evercore ISI now, and set up Strategas, or there was Evercore themselves, Roger Altman and others setting up. Every character was there. And then there was Greenhill. Boy, did they do well for a while. Sonali Basak joins us right now in a stock from 80 to 10 to 15. What did Greenhill get wrong for 8 years?
You know, that's the question of the lifetime. This was the first really of its kind to go public. It set the stage for the Perella Weinbergs, the PJTs, everyone, Ken Moelis to go public. They faced a lot of competition. That is competition on paying bankers for deals in one of the biggest boom cycles for mergers and acquisitions. And then they had already left the restructuring wave back in 2008 as well. So again, Greenhill, both on profitability, competition, as well as just winning share on deals. They've dropped off the league tables very significantly in recent years. This $15 share per cash stock price, deal price here, it was trading at $6.70 or so back on Friday. It's double, more than double what it was trading at very recently.
So then the other question is, why is Mizuho going for this?
Well, you know what it does. Remember, Mizuho actually was not an M&A investment bank. Mizuho has debt and equity capital markets, and in recent years has been hiring M&A bankers. So buying Greenhill gives it an immediate presence around the world in M&A. And by the way, the bet here is that they already have a balance sheet.
Okay, the elephant in the room here is that Japanese banks have a history of getting into businesses right before the economic cycle turns. I just think about 2006, 2007 with Mizuho getting into CDOs and all sorts of derivatives tied to them and tied to mortgage debt. How much are people saying that there's something similar going on here versus a real beginning, or at least entering at a good time for the M&A business?
You know, it's a good question. And I asked the question to Mizuho, is really the top executive here in the United States. I asked why $15 a share when they were trading at less than $7 just Friday. And he said, listen, before the regional bank sell-off, this is what they were trading at. We think this is a fair price. To defend the Japanese a little bit here, MUFG had also made that Morgan Stanley deal in 2008 that has paid off over and over and over again. Think just as recently as Elon Musk and Twitter. That put MUFG on the deal next to Morgan Stanley. And so the idea here is that they can win if they buy cheaply here.
Real quickly, we're out of time, but this will be a study much more through the day with your reporting and Bloomberg reports at Greenhill to be taken out by Mizuho. Rule number one, you got to keep the horses. How does Scott Bach and Mark Lasky keep the troops?
Well, I think one thing they could do is buying more troops from Credit Suisse. So I think they have an opportunity here to add on more bankers at a time.
Listen to you. She's like knee deep in it. I mean, you know.
You know, I've covered Greenhill for a decade, and what's interesting is Mizuho actually used to have a stake in Evercore. So buying these banks is not easy. And to Tom's point here,
you got to keep the troops.
If you don't keep the troops, you don't have a bank.
Yeah, it's just that simple. Sonali Basak, thank you so much. Her reporting this morning of Greenhill, taken out by Mizuho. It's about a double. We'll get the share price up for you, but certainly far away from the excitement and enthusiasm of 2010. Futures advanced from zero, even red on the screen, up 5. The VIX 17.06. I'm watching a 2-year-old. Wow. Basak walks in the studio. Weeks about a 4.29%. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China has questioned the sincerity of the Biden administration as it pushes to resume high-level diplomatic talks with Beijing. Chinese Foreign Ministry spokeswoman saying, quote, the U.S. side asks for communication on the one side, yet on the other suppresses and contains China by every possible means. President Biden says he expects ties with China to improve very shortly, dismissing an alleged spy balloon that caused a diplomatic spat earlier this year as, quote, silly. China is likely to see its COVID-19 wave peaking at about 65 million infections a week toward the end of June, according to a senior health advisor. Now, this comes as authorities rush to bolster their vaccine arsenal to target the latest Omicron variants. XBB has been fueling a resurgence in cases across China since late April and is expected to result in 40 million infections a week by the end of May. General Motors' new president of North America, Rory Harvey, spoke to Bloomberg's Matt Miller about GM's new line of electric vehicles.
We're absolutely all in terms of EVs as an example. You know that Escalade has been sort of dominant and iconic in the large SUV segment for over 20 years now. And if you looked at the current Escalade in terms of the ICE configuration, it's sort of segment leader. And if you then complement it with a ground up all new Escalade IQ, it's absolutely fantastic news.
GM says it will begin producing the Silverado EV pickup truck this month. You can watch Harvey's full interview with Bloomberg on the terminal. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
What we want to reduce is more like the bill of material cost, the industrial cost in the plants. So our cost we want to get out is actually in the heart of our industrial system. It's not like just people.
You have said in the past you have 25% more engineers working on the same output as your competitors. Does that mean you're going to reduce that 25%? Are you letting it happen through attrition? How's it working?
I think you're going to see from Ford over many years a natural reduction, not through attrition, but skill mismatch, intentional transition of our teams, moving some of the engineering to lower cost labor sources. So it'll be a combination of things, but it's obvious that we have to be more efficient.
James Farley's Ford is CEO, speaking with our Matt Miller. We're going to go to Mr. Miller here in a moment, out in Dearborn, which is the land of Ford and all the changes they're doing, particularly in the EV area as well. Right now, we got to churn to the markets up too, but we have the bond markets moving. For those that have been waiting for Fed speak, and Lisa, I'm as guilty as anyone making jokes about the yawners. It is not a yawn by the gentleman from St. Louis this morning. James Bullard moves yield higher.
He's speaking in a moderated discussion in Florida, saying that U.S. recession probabilities are overstated and expects to raise rates twice more this year in order to get recession under control. He said the labor market is slowing some, but that does not mean recession. Again, the idea of 2 more rate hikes this year flies in the face of what a lot of people are either pricing in or saying at the Federal Reserve. But to me, this is really the distinction that we keep hearing from Fed officials. If they think that things are too good, that is bad for markets because that means they're going to raise rates further to curtail some of the credit creation.
Let's review this, and I do think this is important, folks. Bullard has been a collegial outlier, agreeing with others that have been leading the charge, including the former New York Fed President Bill Dudley here. But a while back, he was giving scope and scale to a really significant reset in interest rates without any whisper of disinflation. I see a recapitulation of that this morning. Bullard saying inflation staying too high. One reason for more hikes, plural.
And this
We're very plural this morning.
Well, and this is sort of the distinction between the skipping of the June meeting or the pause, right? The skip being there might be more needed, especially as you get data that's come out hotter than expected pretty much across the board.
And what we see is, a better economy, and that may include new cars, including new expensive cars from Dearborn. With a perspective on his world of autos, Matthew Miller joins us from Dearborn, Michigan, which can only mean Ford. Matt, I don't know if you brought it up, but the Ford family has enjoyed the Detroit Lions since 1934. Did you and Jim Farley talk about the resurrection of the NFL team from Dearborn?
We did not. We focused pretty specifically on cars and the business of making cars this morning.
Well, the business of making cars is EV. You're knee-deep in this. As a general statement, who in Detroit is winning the EV awards, Barra or Farley?
Well, Farley is winning the war as of now, right? Ford is the #2 producer of electric vehicles in the United States. Only Tesla produces more, but Tesla produces and sells a heck of a lot more. So what they want to do is kind of narrow that gap and get closer to overtaking Tesla. They want to put out 2 million EVs by 2026 with, very importantly, a margin of about 8%.
So the sort of distinction right now between a lot of the EV producers and frankly between the Detroit Lions of GM and Ford is that GM said that they didn't think that they had to cut prices in response to Tesla's price cuts, but Ford did. Why? Do they not have that pricing power?
No, well, Ford, you're right in pointing out that distinction, and it's stark, I should say. Jim Farley is, I think, very realistic in his expectation that once production comes back online to the levels that we've previously seen. You know, we were running at a 17 million SAR in 2019, and now 15 million is like the top. So once we get back to that previous level, you're going to see so much more competition in this space that price cuts are going to be a thing of necessity. Yeah. They're going to have to do it, according to Farley, and GM will have to capitulate as well.
This is a really important story from a macro perspective as well, which is that essentially autos have driven some of the inflation that we've seen. And if you start to see the opposite, well, that will flip things on their head. How much is this a Ford story, and how much is this an industry-wide story?
The inflation is definitely an industry-wide story, but Ford has its own unique piece of this in that they pay a lot more to make their cars than their competitors. Jim Farley has identified, I think, $6 to $7 billion of what he calls cost disadvantages versus his competitors. So they're really working on pulling those out of production. And engine story more than an electric story, because electric car production, they're starting now and they can nip those costs in the bud before they form. In terms of the ICE story, you know, they haven't built a new factory in 50 years, right. So they really have to go back and look at everything in order to get those costs out.
Matt Miller with us in Dearborn. We're going to go to some breaking news and come back to Mr. Miller here. This is, of course, AIDS. I got to be careful here. This is not the president sleeping after a long trip back from Japan. It is not the Speaker of House beginning his morning. This is McCarthy aide commenting on negotiators arriving soon at the Capitol. The soon here is the news.
9:15 a.m. is the time. What's interesting is we haven't really gotten a concrete time, or at least not one that I've received, as to when McCarthy and Biden will meet themselves. Negotiators, though, are arriving ahead of that, presumably in the next perhaps 20 minutes to get some sort of start on these discussions.
So we'll continue to monitor that into the 9 o'clock hour. Matt Miller, I'm absolutely fascinated by how people in Detroit, in the Matt Miller auto world, never bring up shareholder return. I look at the 10-year returns of the auto companies, and they're just flat out unacceptable. In your conversation with Jim Farley today, is there any discussion about how to drive shareholder return?
Well, that's exactly what Farley and the whole team are doing right now behind me. They're talking to investors, they're talking to analysts about how they can boost that over the next few years. And frankly, they see a different world post-IVE than pre-IVE because you know, it won't be about the vehicles, Farley has said. It's not about the shell of the car that's going to make them money. In fact, you could see margins come down on the actual vehicle sales. It's really about the software and services. That's where they see their growth coming in. And they have an example in Ford Pro, which is their commercial arm in terms of serving, you know, plumbers and electricians across the country. The profit there has been a level that's exponentially higher than what you get in car making. And they want to turn the whole business that way so they can boost shareholder returns.
Matt Miller, thank you, from Dearborn, his conversation with Farley of Ford Motor. Futures up 2. That's really not the story with red and green on the screen. Lisa, I'm sorry, it's about a yield giveaway. The 10-year yield 3 basis points higher. We have, well, no, we do not have further curve inversion, but still set at 61 basis points shows attention Friday and today. And the real yield to me is important, 1.45%. There's just a higher rate regime here off of the Bullard comments.
2-year yields are the highest, about the highest, going back about 2 months. So that's where we're at as we reset in this churn. If the market believes the Fed that they're not going to cut rates or need to cut rates, how much does that tighten credit conditions without the Fed doing anything different from what they've already said they're going to do? What if they don't really hike rates at all further for the rest of this year, but they just don't cut? That will tighten given the fact that people are still pricing in 2 cuts by year end.
And I'm waiting for the disinflation path from the gentleman from Indiana University. He says we have a good shot at getting back to 2% inflation. So there's the round trip from 2 rate hikes up, as he alludes to, no recession in sight. You know, he hedges that. I'm being a little too strong there. I love this. Households are flush. Did you feel that way this weekend? how about those summer camps?
You know, yeah, exactly. Households without kids might be flush. Ones with them never are.
Has Jim Bullard ever got the summer camp supplies email? And then you're flush.
The packing list?
You know, Dr. Bullard, the packing list. And we want you to bring a few things with you.
Yeah, I want you to bring 25 shirts and 55 socks.
Exactly.
I mean, honestly, the one thing that I think is important to note that is he's not a voting member, right? So how much do we give more weight to certain members than others? This is an active discussion. They are trying to signal something to the market, perhaps more than following through with this type of action.
I've never put much weight in that, and Mike McKee does. He puts a lot more weight in it than I do. I'm just looking at who they are, what they believe in, and James Bullard has made very clear he has an optimism about American economic growth that doesn't get you to the gloom of recession. It's been a fascinating Monday. I don't know what else to say about it. Congratulations to our chief financial correspondent, Shonali Basak, reporting on Green Hill, taken out by Mizuho. We move forward. Good morning.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. Let's get your week started. Equity futures just about unchanged on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the president returning from Japan to problems at home. As Yellen doubts the U.S. can pay its bills beyond mid-June, Fed Chair Jerome Powell tees up a break from hiking rates. We begin with the big issue. Talks between the president and Speaker McCarthy resume. Kevin McCarthy says time is of the essence.
He's now bringing something to the table that everyone said was off the table. It seems as though he wants default more than he wants a deal. That's not where I'm at. I will never give up.
President Biden throwing the ball back in his court.
Now it's time for the other side to move from their extreme positions, because much of what they've already proposed is simply, quite frankly, unacceptable.
With tensions growing, time is running out. As of late last week, the Treasury's cash balance stood at just over $57 billion, down from $140 the week before. Treasury Secretary Janet Yellen says the U.S. is unlikely to be able to pay its bills by the middle of June.
Well, there's always uncertainty about tax receipts and spending. And so it's hard to be absolutely certain about this. But my assessment is that the odds of reaching June 15th while being able to pay all of our bills is quite low.
Economists at Goldman Sachs agree. The early June X date may well be real. They say this: there is certainly a chance the receipts could slow more than expected and leave the Treasury short of cash by early next month. Team coverage starts right now with Anne-Marie joining us from Tokyo, Kelly Lyons down in Washington, D.C. AMH, first to you. The G7, you and I talked about this. Did we even get a G7 this weekend?
We did. We certainly did get a G7, Jonathan, especially when you look into some of the intricacies and the language regarding China and President Zelensky here. There was a lot of emphasis on Russia, but obviously what loomed very large, the very big elephant, if you will, in the room for President Biden as he sits across from other world leaders, of course, was whether or not the United States would, in fact, default or not. This is something that, whether it was the G7 finance ministers meeting in Niigata, where I sat down with Secretary Yellen, or if it was the leaders' ministerial meeting in Hiroshima, the debt ceiling is what everyone was concerned about, because they are worried about the economic risk that may be emanating from Washington. And Jonathan, of course, this was one of the biggest talking points because President Biden had to cut his trip short. This is a strategic foreign policy goal for this administration to make sure they're active in the Indo-Pacific, and they had to cut their trip short, not going to Papua New Guinea and not going to Australia. And instead, the president went home last night, and the person he called on Air Force One was Speaker McCarthy.
And Katie, those talks resume again this morning, throughout this afternoon. Katie, what are you focused on through today and through this week?
Well, frankly, it's going to be whether or not a deal can be completed and get to the floor of the House this week, John, because remember, it's May 22nd. We are now 10 days away from June 1st and theoretically the earliest potential date that the U.S. defaults. So time is very short here as we prepare for the president and the speaker to meet in person today after their phone call yesterday, which Anne-Marie mentioned. And of course, their aides, those focusing on these negotiations for the two parties, did meet for 2 hours last night. But we understand really the points of contention here are now around the idea of spending cuts and spending caps. Republicans previously had wanted 10 years worth of spending caps. We understand, based on our reporting here at Bloomberg, that has now come down to 6. The administration, though, wants those spending caps to last just 2 years. There's also the idea of where spending should be cut or not. Republicans would like to see more defense spending, which would mean more cut to social programs. That is a difficult proposition for Democrats. The idea of work requirements for entitlements as well has become a sticking point because now in these talks, the formulation of a deal has to consider whether or not it could get enough support from both chambers of Congress, because there are issues that Democrats have, work requirements and spending being one of them, and Republicans have other red lines as well, and that makes it difficult to see how the caucuses could come together and actually get this thing passed, assuming a compromise can be made in the coming days, John.
We've had a weekend full of mood music headlines, Anne-Marie. We discussed that earlier once again. We're all sick to death of it. Just follow the money. The cash balance of the Treasury is just going down, 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 down. As a practical matter, AMH, how much time is left?
Well, if you take Treasury Secretary Janet Yellen for her word, what she's assuming and trying to work on is the fact that she's considering June 1st a hard deadline. And what she said in that, she doesn't think they're going to have, in that interview with NBC News over the weekend, is she doesn't think that the Treasury will have enough money to make it to June 15th, potentially when they have another realm of tax receipts coming through. And Jonathan, that is precisely why you see this momentum of Speaker McCarthy and President Biden getting in a room together today. And before they get in a room, in about 10 minutes time, the White House negotiators will also be at the Capitol. So you're going to have another round of talks between the GOP and Biden's negotiating team before Speaker McCarthy and Biden sit down. So it does seem like they are trying to move on this. Why? Because they are concerned about this June 1st deadline. It's why the president had to cut short a very important trip to Papua New Guinea and Australia as they try to talk tough on China, because he wanted to make sure he was home so that they didn't default.
We're going to talk about China in about 40 minutes' time. Stay close, guys. AMH, Kelly Lyons on the latest on the debt ceiling negotiations down in Washington. Joining us now to discuss, Aberdeen's James Athey, Columbia Threadneedle's Gene Tenuzzo. Gene, first question to you, sir. The House Speaker says time is running out. How much time do you think is left?
Well, I will take Treasury Secretary Yellen at her word that next week is a hard date. There's probably a little cushion baked into her forecasts in order to, give the administration a little bit more time. But the fact of the matter is, John, if you look at the Treasury bill market right now, there's not a lot of stress baked in specifically around the debt ceiling. So I have a hard time believing that even if we get a bill passed this week, let's say, that we see a huge sigh of relief in the bond market.
James, do you think we need to get closer to an accident before we get closer to a deal?
Yeah, generally that's been the case, isn't it, John? Unfortunately, we're dealing with a lot of ideology here and not necessarily a lot of economics. There are seemingly some fairly hard red lines, which, again, just come from the underlying beliefs of the actors and the parties involved and don't really bear any resemblance to the on-the-ground economic reality that we see in front of us, and that's always a very tricky situation. I would have thought the fact that equity markets seem to be carrying on regardless does just lift a little bit of external pressure, and maybe we need to see that situation change to force a deal over the line.
I think we've all seen a ton of scenario analysis. UBS puts them out. What would happen? What if? This long list of what ifs. Worst case scenario outlined by the bank. would be marked by a prolonged one-month delay in all US payments. They said it would lower GDP by an additional just 0.8 percentage points, 700,000 job losses, cause a 30% immediate drop in stocks. Of course, they stress, Gene, that this scenario is, quote, very unlikely. Gene, a lot of people watching this conversation, listening to Katie, listening to Anne-Marie, listening to you, listening to James, they just sit there and say, this is pointless, it's a waste of time, they're going to come to a deal and we'll all move on. Gene, do you consider this all a waste of time?
Well, look, John, Congress has raised the federal debt ceiling 78 times since 1960. So building an investment strategy that the 79th time is the charm is a very difficult thing to recommend. I agree the political dynamics are different this time, but no party has an incentive to get a deal done any earlier than the deadline, the 11th hour, but both parties have an incentive to get a deal done. So we do think it's going to happen, but you have to plan for the worst case, just in case.
Well, what's the base case, James? Not the base case, not the worst case, the base case. Less spending, weaker growth. Is that the outlook, James? Is that your base case now?
Yeah, I mean, I completely agree with Gene. You can't really think that this time is necessarily different because this situation has been going on for years and years and decades and decades. Indeed, if we look back at 2011, actually a lot of the damage in markets was done after the deal was done because almost by definition, not quite, but almost by definition, you need to see something given to the Republicans to get them on board. And of course, that's likely to take the form of spending cuts, and that's a growth headwind, which I don't think is at all baked into markets at the moment. So I think we get a deal. I don't think anybody is delighted about it, but everybody's somewhat satisfied. But I do think there is still downside risk to equities and bond yields from the fact that it's likely to be impeding growth going forward.
Well, perhaps oddly then, Gene, are you in the same boat? Is this the kind of situation that makes you more comfortable, not less comfortable, more comfortable owning treasuries?
I think longer term treasuries, yes, John. We do believe that. I think growth has continued to slow. If you look the last 5 quarters, basically since the end of 2021, growth in the U.S. has been less than 1% on a real basis annualized. So that sort of run rate of growth is quite low. And if we were to see a shock to the extent that James described, I think that could be enough to bring us into mild recession. So I think, from that standpoint, longer-term treasury yields have room to go lower simply from a growth standpoint, not to mention the potential flight to quality that could come from a debt ceiling. I still think on the shorter-term side, as we continue to digest comments from the Fed, including Bullard this morning, and as we get closer to that June FOMC, I think that 2-year yield still has room to rise. So I think this inverted curve can get more inverted from here.
Well, that's a call. Right now, yields higher at the front end by 3 basis points, just short of 430 on a 2-year. Jim Bullard of the St. Louis Fed, if you are just tuning in, said he's thinking 2 more rate hikes this year. We'll wrap up the Fed speak in just a moment. James Athey, Gene Tenuto, sticking with us, looking at the equity market going into the opening bell. About 20 minutes away, equity futures pretty flat here. Let's get you some movers. Here's Abby.
Beneath the surface, John, there are a number of movers, especially to the upside, which we'll start off with, and then to the downside. To the upside, we do have regional banks popping. PacWest higher on the announcement that they're going to sell $2.6 billion in real estate loans related to construction to Kennedy Wilson. That stock soaring. Investors really sighing some relief there. KeyCorp raised to buy at Odeon Capital. They've also set a price target of $11, also higher, up 2.2%. To the downside, though, Micron down 3.6%, well off of its down 6% lows, as China says that some of their products were found to be a cybersecurity threat after a review. Beijing warning operators against buying the company's goods. And then finally, Meta down 0.7%. They've been fined a record $1.3 billion in the EU over U.S. data transfers, warning the company to stop transferring users' data to the U.S. For a company that is scheduled to make $127 billion this year, though, John, it seems at $1.3 billion, it's not so much. The stock down mildly.
Abby, thank you after a massive run year today. Coming up, Chair Powell, seemingly prepared to skip June.
Having come this far, we can afford to look at the data and the evolving outlook and make careful assessments.
That conversation up next.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
We've come a long way in policy tightening, and the stance of policy is restrictive. And we face uncertainty about the lagged effects of our tightening so far and about the extent of credit tightening from recent banking stresses. Having come this far, we can afford to look at the data and the evolving outlook and make careful assessments.
This is never a good ingredient for a good panel when your panelist is sitting there just reading prepared remarks. That was Chairman Powell reading carefully from those pre-prepared remarks, teeing up a break from hiking interest rates. One hawkish member of the Federal Reserve open to the idea. Minneapolis Fed President Neil Kashkari telling the Journal, if the committee chooses to skip a meeting because we want to get more information, I could make the argument why that makes sense. A skip to get more information is very different in my mind than saying, hey, we think we're done. Jim Bullard of the St. Louis Fed indicating he certainly isn't done. Quote, we're going to have to grind higher. I'm thinking 2 more moves this year. Mike McKee joined us to wrap it up. Morning, Mike.
Good morning, John. Well, what happens when the Fed chairman speaks and nobody listens? Take a look at where we are in terms of the market's view of where we'll be in January 2024. They had been forecasting at least 3 cuts, and now we're moving higher. It looks like Jay Powell on Friday had a very small effect, but it did not last very long. And so at this point, we're looking at Powell's compatriots to see where they are. And as you mentioned, Neil Kashkari getting some traction in the headlines on this we could skip thing. But basically, he moved ahead and said to the Journal and also on CNBC today that we may need to get to 6%. And it's important to me that we're not signaling that we're done. And as you mentioned, Jim Bullard saying we're going to have to grind higher. I'm thinking 2 more moves this year. So we're seeing a majority of those who've spoken out so far suggesting that there is a lot more work to do, that inflation's not coming down as fast as they hope. So we may get into this skip versus pause idea. As you could see there on the calendar, we do have some more Fed speak after Bullard today. I'd look to Mary Daly. She hasn't said a whole lot so far. And also Chris Waller on Wednesday, along with the Fed minutes. Those 2 things should give us some real clues. Waller's been relatively hawkish, and he has a vote. So which way is he going to go? In the Fed minutes, what did they talk about at the last meeting in terms of the idea of a pause?
And Mike, do you think the bar is higher right now to skip June or to hike in June?
Well, I think it's about 50-50 right now because we don't have all the data. Friday, you saw on the calendar as well, we do have the PCE inflation numbers. That could influence the Fed. We'll see if they come down at all, especially in the core. And, of course, they get the jobs report next week, and we get the inflation report, CPI, just before the Fed meeting. So most of them wait and see until the last minute whether there's any progress that's been made.
Mike McKee, thank you, buddy, as always. Gene Tenuto, James Athey, back with us. Now, Gene, the St. Louis Fed President Jim Bullard says he isn't done. He indicates maybe 2 more hikes this year. Do you still think this Fed is done?
I do think they're done. I think it's important that we got confirmation or at least some confidence in that from Powell on Friday. And I think it's important that Kashkari, who is on the hawkish side of the committee, is seeming open to pausing as well. I think what the Fed wants, and the reason we're hearing all of this language from Bullard and several speakers last week, is that they want optionality. They don't want to be boxed into a corner that they have to be on hold and that they perhaps have to cut later in the year. I think at the end of the day, if you have to put your chips somewhere, I'd put them on the Fed this year, being able to hold the line and hold rates. And then I'd put them on the market next year in terms of being more likely to bring rates down, maybe even in a meaningful way.
James, how important is the difference between a pause and a skip?
I'm not a massive fan of these linguistic acrobatics that central banks end up getting themselves into. But, you know me, John, I'm generally pretty critical of central banks. I think the Fed's done the best job out of the majors in the last, since their dovish mistake. I think the communication from Jay Powell and Neil Kashkari there, that's pretty much spot on, really, given where we are. They both recognize that a lot of work has been done, that obviously today's data is telling us something about yesterday, not about tomorrow. And of course, there is still a lagged effect from prior tightening, which is latent, which is not really yet acting on the economy. And so taking a pause just to buy themselves another month's worth of data, it's not like inflation has started going back up again. Now, of course, the jobs market has been stronger than expected. If they can get a bit more data, get a little bit more clarity on the direction of travel for the labor market and the extent of core disinflation, I think they would feel more comfortable making a decision to hike at that stage. But my base case, like Gene, is that they're probably done here. I think we're going to see some of this data rolling over a bit more significantly in the coming months.
So, Gene, tell me, if you think they're done, why do you think yields keep pushing higher at the front end? 7 consecutive days of this now, up another 3 basis points on a 2-year, close to 430. Gene, you mentioned briefly that you think maybe there's a little bit more space there and that this curve inversion has got a way to go. Why?
I think that's the battle the Fed's going to continue to fight through the rest of this year. Remember, the Fed funds rate already is 5 to 5.25. So the 2-year yield is somewhere around 100 basis points below that almost. And the Fed wants the market to believe that they could stay put for a while, and they want to push that 2-year yield closer to where the Fed funds rate is. And in history, in other cycles, we have seen them be successful at that. So I think they would view that as having more optionality. Ultimately, I think they'll be able to do that for a while, but I think in the end, they will be at a point where they'll have to ease probably next year, and that's when we'll see really yields come down in a more meaningful way.
Gene, is inflation going to allow them to do that?
I think it will. In fact, base effects are going to be very helpful starting in a month or two here. We're going to get likely CPI with a 3 handle instead of a 5 handle. Now, that's not quite at their target, but it's making significant progress. And in the second half of the year, we should get a lot of help from the owner's equivalent rent side of things because the lagged effects of housing. So I think, yes, I think ultimately inflation will move from being a headwind to being a tailwind for their mandate.
Well, let's talk about what that means for the longer end of the curve. You mentioned a 2-year. Maybe there's some space to move higher. 430 right now on the screen. 10-year at the moment, just south of 370. Gene, what kind of levels are you thinking about at the long end? What are we coming down to?
Well, it's hard to pick a date and a number, but I think as we move forward, moving closer to a 3% level on the long end of the curve for like a 10-year treasury is much closer to fair value. And even if you take the Fed at face value in their summary of economic projections, their long-term forecast for the average short-term interest rate is 2.5. So I would view the gap between 2.5 and where long-term yields are today as a Fed credibility risk premium. And as we get closer to their 2% inflation target, that should narrow.
James, would you go with that?
Yeah, I agree with Gene's analysis there, absolutely. I think that the bar to getting 10-year rate down to about 3%, a little bit on the high side, because at the moment we're still in an inflationary regime, and so there'll be some positive risk premium, term premium, inflation premium. But I do think the front end's interesting. The front end obviously reflects a probability distribution, looking at pricing and saying, hey, look, the market thinks the Fed's going to cut 50 this year. I don't think that's the right way to go about it. If you start scribbling down, probabilities of them doing another 25, another 50, then being on hold, or them even cutting, a little bit, cutting back to neutral or cutting a lot, you can quite easily get to the kind of downward slope that we've seen in recent weeks. And so I don't think that's as obviously a slam dunk to be short, depending on your subjective probabilities of the likely outcomes. And of course, that's a decent yield to own in the front end, pretty risk-free when risk assets look rich. So yeah, sure, there's time decay. If nothing really happens, you're going to lose a little bit of money as that 2-year rate just sort of rolls back up the curve. But I think you buy yourself a lot of optionality, because we've already seen that within the financial sector as well as within the economy, there are potentially some significant potholes ahead of us.
Yields a bit higher this morning at the front end. Gene Tenuto, James Athey, to the both of you, thank you. Federal Reserve speakers right now doing their best to suggest if it's a skip, it's certainly not a pause, and then you get people coming on this program who just hear they're done. They're done. We'll see if they're done. Equity futures right now unchanged on the S&P 500. Coming up the morning calls, and later Bank of America boosting its equity outlook. Morgan Stanley sounding the alarm. We'll get the outlook from JP Morgan's Elise Ossenbaugh. That conversation still ahead. Your opening bell 7 minutes away.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
5 minutes away from the opening bell this morning. Good morning to you. Equity futures just about unchanged on the S&P 500. That's the price action. Let's get you some morning calls. First up, UBS upgrading DraftKings to buy, expecting stronger revenue growth due to the company's rapid U.S. expansion. Next up, Williams Trading downgrading Nike to sell, seeing a challenging U.S. environment with a weakening product mix and cautious consumers. That stock is negative 1.5%. And finally, Loop Capital downgrading Apple to hold, saying macro headwinds are starting to weigh on demand for the company's iPhones. That stock slightly negative, down by 0.83%. Coming up, Morgan Stanley pushing back against the rally. We get the view from JP Morgan's Elise Ossenbaugh next at the opening bell. From New York City, your opening bell up next.
think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Seconds away from the opening bow this morning. Good morning to you. Equity futures unchanged on the S&P 500. A week of gains last week, a decent week of gains, the biggest week of gains on the S&P going back to March. On the Nasdaq 100, 4 consecutive weeks of gains on the Nasdaq. Equities keep climbing higher. There's the opening bow. Switch on the board and get to the bond market. Yields climbing higher for a 7th consecutive session. Yields up again by a basis point or 2 on a 10-year, 369 on a 2-year, still climbing every single day last week and some. Up again this morning by 3 basis points. A very brief break of 4:30 as the St. Louis Fed president, Mr. Bullard, speaks again and tees up from his perspective what he would like to see as a couple more hikes. In the FX market, the euro against the dollar, that currency pair negative for a second week last week and trying to bounce and not doing a good job of it. 108.10 on that currency pair at the moment, and crude totally unchanged. Call it a snooze, 71.55 on WTI. About 30 seconds into the session, equities just about unchanged on the S&P and on the Nasdaq. One stock to watch at the open, Micron. Shares under pressure after China announced its products failed to pass a cybersecurity review. The CEO of Micron saying, quote, "We're evaluating the conclusion and assessing our next steps." Abby has more. Hey, Abby.
Hey, John. So the stock is down about 3%. Its worst day since early April. At the lows, down more than 6%. Its worst day of the year. This as investors assess what this means. So at a headline level, it's clearly bad. China is saying that these chips, both NAND and DRAM, that there's a cybersecurity threat, did not pass a review, so they're barred. But when you dig in a little bit deeper, you have to consider a few things. First, how much revenue is from China? It's about just mainland China, it's about 11%. If you add Hong Kong, it's about 16%. But it's a very specific barring, if you will. It's of their critical infrastructure operators. And if you look at the revenue from last year in terms of this piece, it was roughly 20% of its revenue from last fiscal year was from the enterprise and cloud servers. So then if you times that by the mainland China, it's maybe about 2% of revenue. So that's probably why the stock is off the low. But nonetheless, some analysts out there saying that it could also contribute to a problem for their gross margin recovery. And again, from a headline perspective, it's not great. And tensions between the U.S. and China around technology, not great. But for Micron, it wouldn't be surprising to see if this stock works off of these lows, John.
The stock is negative by almost 4%. Abby, thanks for that analysis. Just amazing to hear the president say relations between the U.S. and China would improve, quote, very shortly. And very shortly after that, this news dropped. That stock is negative by 3.5%. I can tell you, Katie Lyons in Washington, AMH over in Japan, joining us again in about 10 minutes to break this story down in greater detail. Want to pick up on Meta. Abby mentioned it a little bit earlier this morning. The company getting hit with a record $1.3 billion EU privacy fine over US data transfers. Meta responding in a statement, writing, quote, "This decision is flawed, unjustified, and sets a dangerous precedent for the countless other companies transferring data between the EU and the United States." Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, can you explain what's gone wrong here for Meta?
Well, so this is the third time they have to pay a fine in terms of how they store data, and the data transfer is something that was highlighted as part of GDPR. They should have complied by now. Clearly, that's not the case. And look, I think from my perspective, this just goes to show the risk they have, both in terms of combining the data across the apps and going across regions. And if regulators don't allow that, that hurts their ad targeting. So in this case, Meta gets about 23%, or based on our estimates, about $27 billion revenue from the EU region. IDFA, we know last year was a big drag on, in terms of the Apple changes and what it did to their revenue. This could be at least, $2 to $3 billion headwind just in terms of the ad targeting side if this was to, be more restrictive.
1.3 billion, not enough to hurt this name. It's had a massive move year today, as you know, Mandeep. The stock is up again by 0.8%. Mandeep, work through this statement together with me. The decision is flawed. It's unjustified. It sets a dangerous precedent for the countless other companies transferring data between the EU and the United States. Are we suggesting here that other companies will get caught up in this?
Well, so think of it this way, Alphabet has been paying fines over the years. They've paid off the tune of, $8 to $10 billion in cumulative fines. And in this case, for Meta, this isn't going away. This is not the last fine that they have paid. And clearly, when we're talking about large language models, it's about getting more and more data together to train these models. Guess what? They can't even, marry the EU and the US data, even though it's from the same company. So clearly, this will be restrictive in terms of their product development and their ability to target ads.
The stock now up by 1%. Mandeep, thanks for the breakdown of what's gone wrong or what's going right with Meta right now, because what's going right is that stock is absolutely flying year to date. The financials have been struggling, as you know. They've been moving in the other direction, particularly the regionals. PacWest is higher this morning, though, by almost 7%, agreeing to sell a $2.6 billion portfolio of real estate construction loans amid efforts to shore up liquidity. Katie has more. Hey, Katie.
Hey, John. Well, yeah, so this portfolio in particular, it has 74 real estate construction loans. They're being sold to Kennedy Wilson Holdings at a steep discount. Of course, like you say, this move aimed to shore up liquidity, and it seems like investors are welcoming that move. You have PacWest shares rising this morning, of course, still down over 70% for the year. But also in the banking world, I want to talk about Greenhill a little bit, because shares absolutely soaring this morning following news that Mizuho will buy the investment bank in a deal valued at about $550 million. That is boosting Greenhill shares up over 100%. As you can see, some of the other regionals rising as well. We have KeyCorp on there, as is Zions. So really a bit of a lift to the sector, even though we know that there are still some big question marks out there.
Katie, thanks for that. The latest on the financials, the tie-up, Mizuho making some deals out there, PacWest offloading some stuff it wanted to offload. Here's the broader price action right now. About 6 minutes into the session, positive by 0.2% on the S&P. On the Nasdaq, higher again, even with the shift higher in yields. The 2-year right now up by another 3 basis points. Let's call it 430. The last time we had a session where the 2-year yield actually dropped was May 11th. On that day, we dropped by about a basis point to just sub 390, let's call it 389. We've had a 40 basis point move since then across 7 consecutive sessions. Yields keep pushing higher, and this equity market is coping with it and doing okay after finally breaking out above this year's tight trading range. I think one question remains now, it dominates. Are we breaking out? Morgan Stanley's Mike Wilson says the short answer is no. There are many technical signals that conflict with the idea that this is the beginning of a new cyclical bull market. Extreme narrowness, poor breadth, quality defensive leadership, and broad cyclical underperformance. JP Morgan's Mislav Matejka says markets could face a lose-lose situation. Markets need to negotiate what is likely to be an increasingly challenging growth policy trade-off in the second half. The markets in the second half could be caught between a rock and a hard place. Luke Carr of UBS says stocks cannot go higher until DC officially avoids a default.
with equities and about near the top of a 7-month range. It's really difficult to see that now, before this being solved, being the proper time for a real, true, genuine breakout.
Joining us now to discuss is JP Morgan's Elise Ossenbach. Elise, wonderful to catch up with you once again. Do we have the potential here for a positive breakout in this equity market?
Over the near term, we think so. You think about the favorable earnings that came in well above expectations for the first quarter. You think about this debt ceiling overhang that arguably is probably putting a lid on the broad index. And so long as we get a resolution to the debt ceiling, which is our base case, we do think that it's possible in the near term you actually see the S&P 500 break above our year-end target of 4,300.
If equities do break out, Elise, above your price target, are you expecting leadership to change? Stuart Kaiser of Citi was writing about this yesterday. He said it's the #1 question he gets fielded from clients at the moment. Will we get a leadership change if we get a continued breakout?
Not necessarily. I think mega cap tech and other mega cap cohorts are being rewarded because they kind of went through that phase of retrenching and refocusing their businesses. And so investors are starting to gravitate there. But we would actually use those rallies into strength as opportunities to reposition, diversify some risks, especially understanding that a lot of the investors we work with remain well overweight those segments of the market. And we would favor diversifying into areas like Europe or even mid-cap domestic equities.
Let's build on that a little bit more. Savita Subramanian of Bank of America out this morning, raising her outlook over at BofA on the S&P 500. The year-end price target is going from 4K to 4,300. They prefer the equal-weighted S&P to the cap-weighted S&P. They like the cyclical story as well. Elise, does some of that resonate with you then?
Some of it, right? We see pockets of cyclicality that perhaps look attractive. Semiconductors, although they oftentimes get clumped in with that growth complex, to us tell a favorable cyclical story, especially after the experiences of 2022. But on the whole, in the near term, say for the duration of 2023, we are actually favoring the growth factor modestly over cyclicality, again, because of those dynamics that we saw in terms of those businesses adjusting to the environment that we're in and already taking those measures to cut costs.
At least there's a temptation for me to ask you whether you need the Fed to stop hiking or cut interest rates, but I look back at the year we've had and it's yields up, NASDAQ okay, yields down, NASDAQ okay. Elise, just how important is the rate story to the performance of some of these names?
Look, I think there's a lot of emphasis on the macro story, particularly as it relates to the Fed. Perhaps the market is a little over its skis and expecting and pricing in these cuts heading into year end. But for us, there's still a lot to do, regardless of what the Fed might do over the course of the next 6 months. The biggest emphasis that we're placing when we're having conversations with investors is what to do with cash. It is a beautiful thing that you can get 4 to 5% risk-free right now, but we don't think those yields are going to last forever. And so step number one is extending that duration, locking in those yields for longer, but staying nimble within equity markets and especially taking advantage of pullbacks when they present themselves to start adding risk and position for the next cycle.
Elise, how small do you think that window is? And I understand where you're going with this, and I think a lot of other people do as well. If you're in cash right now, you face some reinvestment risk further down the road. Even if you take a 3-month T-bill, say, in 3 months you've got another decision to make. Maybe you can just keep rolling it forward, knowing that the rates are going to stay up here at 5%. You push back against that idea. At least how small do you think that window is?
It really depends. We expect the Fed to probably start cutting rates by maybe the fourth quarter, but definitely the first half of 2024. And we understand that oftentimes these things take time, and there's not much propensity to put all this money into risk right now. So we would like to start that process, make sure we're jumping on the opportunities that have already presented themselves in terms of mispricing. Europe, again, in terms of equities, is a really great example of that. So it's not like an urgent, back the truck up, dump everything you have in cash right now into risk assets, but we definitely want to focus on starting that process, and it's a big theme of the mid-year outlook we're publishing here in a couple of weeks.
At least embedded in that is just the view that ultimately you think then the Fed is done, and just tying this all together, stocks are going to be okay, the Federal Reserve is going to be done, you should maybe go out and take some duration risk at the same time, you don't think we'll retest the October lows. At least is that the ideal case or the base case, and if it's the latter, what informs that view? What's the #1 issue for you?
Base case is that we do not retest those October lows, and also that we do think the Fed is done with this hiking cycle. There is still ongoing stress on the banks, and remember that that is the transmission mechanism of the Fed's policy. So I think the Fed is willing to take a more prudent approach going forward when it comes to policy, and we still have to see how the implications of all of this tightening that's been delivered over the course of the past year and a half kind of play out. But there's a lot of support in terms of offering a floor for the market going forward. And the number one thing I'm pointing to right now is investor positioning. Everyone seems to be bearish. The pain trade definitely is higher. And I think one of the biggest risks for investors is not being positioned for the potential that this market continues to melt up.
Interesting. Elise, wonderful to get your view from JP Morgan Wealth there. Elise Ossenbaugh on the latest. Pushing back against some of the gloom out there. Morgan Stanley's Mike Wilson this morning, I went through that quote. I'll go through it again. There are many technical signals that conflict with the idea this is the beginning of a new cyclical bull market. Extreme narrowness, he's talking about breadth there. Quality defensive leadership, broad cyclical underperformance. Then on the other side, you've got the voice for Elise there, saying more of the same. Savita over at B of A, Savita Subramaniam talking up the cyclical trade, the equal weighted S&P 500. This is what Savita had to say. If you're just tuning in and missed me reading out that quote, I'll share it with you again. We raise our S&P 500 year-end 2023 price target from 4K to 4,300. We prefer the equal weighted S&P 500 to the cap weighted S&P. Double the returns potential, given risks to mega caps. Just a range of views out there at the moment as we continue to grind higher. 13 minutes into the session, up again on the S&P by 0.3% and some, up almost 0.5% on the NASDAQ. Coming up on this program, President Biden expecting U.S.-China relations to improve.
We should have an open hotline. I think you're going to see that begin to thaw very shortly.
And hours after those comments, those relations did anything but thaw. That conversation up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Bloomberg UK, your source for news and analysis. analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
We should have an open hotline. That's what the President Xi and I agreed we were going to do and meet on. And then this silly balloon that was carrying 2 freight cars worth of spine equipment was flying over the United States, and it got shot down, and everything changed. I think you're going to see that begin to thaw very shortly.
The president's remarks come in just hours before China announced that Micron failed to pass its cybersecurity review, ordering key operators to stop purchasing their products with components causing, quote, significant security risk to our critical information infrastructure supply chain. Let's get back to the team. Bloomberg's Anne-Marie in Tokyo, Katie Lyons in Washington, D.C. Katie, what does this mean for Micron?
Well, for Micron specifically, John, it may not actually be that large of a deal financially, because this is a company that is actually less dependent on revenue from China than some of its peers. Only about 11% of its sales come from the country. So analysts seem relatively sanguine about this risk, but note that it could mean additional risk for peers should these semiconductor restrictions spread beyond it to something like Qualcomm or Broadcom, which get a significantly larger chunk of their revenues from China specifically. But this move from China, John, is the first move for a foreign investigation into a foreign firm by their cyberspace watchdog. Again, as you said they found relatively serious cybersecurity risks in Micron chips. They say this is about national security, pushing back against the idea of this being politically motivated. But the U.S. seems to differ, John. The Commerce Department said that Beijing's conclusion had no basis in fact, and that this, along with recent raids and targeting of American firms, is inconsistent with China's assertions that it's opening up its markets and committed to a transparent regulatory framework. And it's worth noting, John, that the U.S. has already taken action in the semi-space against China as well. They blacklisted certain Chinese tech firms, of course, put sweeping restrictions on selling advanced chip-making equipment to China. So there is the sense of this tit-for-tat feeling here.
The timing of this is not lost on anybody. AMH, you were in the room with the president in the news conference over the weekend. You brought up China, direct quote on the relationship with China and the United States from the president. I think you're going to see that begin to thaw very shortly. MH, what's he referring to?
Well, there's really this two-track policy the administration is trying to conduct with China. On one of that's contact. You've seen a bombardment from this administration trying to set up meetings, really a flurry between Secretary Yellen to Secretary of State Antony Blinken. They're all trying to meet their counterpart. Let's see if that strategy pays off. This week, Jonathan, China's Commerce Minister will be meeting with Gina Raimondo of U.S. Commerce, as well as Trade Representative Catherine Tai. At the same time, they are pushing for more, whether it's export controls, sanctions. A lot of talk on the sidelines of the G7 was dominated about the impending outbound investment restrictions. So what China has said in response to all of what Biden said yesterday is, where is the sincerity in this engagement and communication? I asked President Biden directly about, if you want this engagement with China and you want to improve relations, would you consider easing some sanctions? One of those particularly, Jonathan, is sanctions directly on China's defense minister, Li Shangfe. And what you have right now is Secretary Lloyd Austin looking for a meeting with him next month in Singapore. But China says this individual is sanctioned by the U.S. government. Potentially lifting those sanctions would be one barrier out of the way for Austin to sit down with his counterpart. And President Biden told me it is under negotiation. It's under review right now within the administration.
Mate, I've got to squeeze this in. Did Macron's comments come up at all at the G7? His comments directly about China?
His comments likely came up on the sidelines, but not directly in terms of no one was asked in front of a microphone about Emmanuel Macron's comments. What was circulating across the G7, and I know a lot of individuals across these 7 nations saw this article, was what the former prime minister thinks of Emmanuel Macron. What is fair to say, Jonathan, is that that trip and the subsequent interview he did after it and the rhetoric about European strategic autonomy definitely made going into these meetings much tougher. But I think when you talk to officials and they come out and they look at the communique, the fact that everyone's on the same page about de-risking, not decoupling, they think that this was really a win in terms of narrowing that gap between the United States and some European allies.
Interesting. AMH, Kayleigh, to the two of you, thank you. Looking forward to your coverage on the debt ceiling debate throughout the rest of today. Just a timing note for you. This from Jake Sherman over at Punchbowl, reporting that the president will meet with Speaker McCarthy around 4:30 p.m. Eastern time today. That is 4:30 p.m. Eastern time today. There has been, I've noticed a trend over the last week, a willingness to meet and talk around the closing bell and after the closing bell. So it will come after the closing bell. According to the reporting from Punchbowl, President Biden will meet House Speaker Kevin McCarthy around 4:30 p.m. Eastern time. Let's get back to the market action for you. About 23 minutes into the session, just about positive on the S&P with some sector price action. Here's Abby.
Well, John, with that small gain, we do have more sectors higher than not, although some are slipping now. To the downside, we have Staples down 0.6%. This is Target and Walgreens drag. Energy down 0.3%. Chevron down almost 2% on the news that they're buying a shale driller, PDC, in a $6.3 billion stock deal. So interesting. Communication services, the best sector by far, up 1.8% as we have Meta reverse those losses, now up more than 2%. And on the year, John, if we take a look at that sector, up 33%. Take a look at Meta, just ridiculous, up 110% on the year. The stocks also up in a big way, up 26%. And Micron on the year up 31% despite today's loss.
Abby, thanks for that. Your trading diary up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
That push higher in the equity market continues. 26 minutes into the session, we add some more weight to the S&P, even more weight to the NASDAQ. That's the price action in equities. Let's get to the trading diary. We look a little something like this for the day ahead. JP Morgan's Jamie Dimon speaks at 2:30 Eastern time for the Investor Day, plus debt talks expected to resume at 4:30 p.m. between the President and Speaker McCarthy, according to Punchbowl News. More Fed speak, Bostic, Barkin daily throughout the day. Tuesday, another round of new home sales. Wednesday, the FOMC minutes, and rounding out the week with US PCE inflation and UMich sentiment survey coming up on Friday from New York City. Thank you for choosing Bloomberg TV. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. The best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari-sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized